show you how hard it is to forecast in this kind of post-pandemic, not even post-pandemic economic environment. Really, no one actually knows what's going to happen. And a lot of the dynamics that were supposed to aid the labor market in September, the roll-off and those additional unemployment benefits, the return to school, that didn't really happen. And the question is, did that happen to a larger degree in the month of October?
Mike McKee joining us now, our international economics and policy correspondent. Mike, no forecast at this meeting. This is getting hard to forecast, though, so maybe it's a good thing to skip this one.
Well, we kind of know what's going to happen. I think Padraig Harvey was talking about that just before the break. We know they're going to taper. If they don't, the markets would go crazy, and the Fed does not like that to happen. So expect the tapering and expect $15 billion a month as they set up for some sort of rate increase possibility next year if things don't change. And obviously, we've talked about the Goldman call for July and Bank of America fourth quarter 5 rate increases. This is sort of a way station along the way. What's interesting, though, is this is a really big week for central banks around the world, and the market view has shifted. It's now we are going to see action in all of the markets around the world. It's only a question of who goes when and how far do they go. I mean, you can see the Bank of England expected to move this week, and there's a big question about whether the Reserve Bank of Australia tonight moves. There's some close calls, but we're getting market action that's telling us we expect something to start happening.
How closely are central bankers watching stock markets? And I say this because stock markets are giving them a green light if you look at the grinding new highs every day.
Well, they watch stock markets to gauge market reaction, market sentiment, but it doesn't really influence their decision as much as the economic data. You saw there the Reserve Bank of Australia, they had an interest rate yield curve control target, which they let go on Friday. They did not defend, and you saw the 2-year rate skyrocket there. They're all kind of getting ready because inflation is high, and we are getting a little bit back to normal. They're all getting ready to start moves, and so it's going to be a question of how far do they go and when do they feel they have to go. And I don't think stock markets, unless they crash, are going to have a big influence on that.
But does it not matter where the inflation is coming from? Because we've had a lot of kind of materials, commodities related inflation. But on the wage front, we saw, as Lisa's pointed to many times, the employment cost index within the data on Friday. Is that the kind of inflation that central bankers have to pay more attention to?
It's the kind of inflation central bankers have to pay more attention to. The question is, does that kind of inflation continue? Do we see a series of higher wage gains for workers, or was this a one-off as they try to get people back to work? It doesn't look at this point like there's a wage price spiral developing, but that's what the Fed and other central banks have to keep in mind as they go forward.
Mike, has the Federal Reserve failed to divorce the idea of tapering bond purchases with rate hikes?
I don't think so. I think they have divorced the idea, but even the Fed admits that they're tied together in this sense that they have made it clear they do not want to start raising rates until they are finished tapering, because then you're working at cross purposes. You're adding some sort of stimulus to the economy at the same time you're taking it away. So the timing of when the Fed would finish would tell you something about when they might be able to start raising rates, which is why Goldman moved it up to July 27th of 2022. Let's all make a date to be here for that. And we'll see what happens. And that also gives them time to see if inflation is indeed transitory, if it starts to fade as we go into 2022. And interestingly enough, an awful lot of economists are predicting that's going to happen. So it isn't clear that it's going to be a rate increase right away yet.
Mike, how much flexibility do they have on the unwind of that bond buying? Could they go a little bit quicker? Do you think we could get a sign of that at this meeting?
They could, and that's one of the things that some economists are pointing to and saying that Jay Powell needs to do in his news conference, that if he says it's on autopilot, then that leaves the market uncertain about how they react to inflationary pressures if they continue. So they're kind of expecting him to say, we will adjust if necessary. We don't think it'll be necessary, but don't think we're going to be on autopilot as you did during the last taper. We are going to react to the data as they come in.
Are we taking bets on whether you get the last question or not? Mike, are we doing that this time around?
Yeah, probably you should, and see if you can make any money on it. I wouldn't know how to place a bet on myself.
Mike McKee, thank you, sir. You've got to catch up. I've got no idea, Lisa, what happens next year. let's be clear. No one with any certainty has any idea of what happens next year. For market and market participants, what matters is the changing probabilities around what will happen next year, and that's shifted markedly when it comes to rates in the last several months.
What's the benefit to Fed Chair Jay Powell pushing back on the idea of rate hikes that are baked into markets? Michael Gapin of Barclays wrote in saying, I'd be shocked if he pushed back on rate hikes. Yes, taper and rate hikes are separate and have different criterion, but that's about it. I do wonder what a shorter cycle looks like, given how much debt is out there.
Well, if we're going to have a shorter cycle, can risk assets hold up? Ultimately, isn't this what Tony Dwyer started this conversation with?
Yes.
At the top of this segment? The look to everything. Tony's view is that if you don't have a recession, equities keep going higher, from the bottom left to the top right.
Well, what triggers a recession, though? Honestly, at this point,
well, you just used the term shorter cycle. I would assume that's what you mean by that.
Right. So what's the trigger? And I think that that's the distinction, right? How much is it going to be a policy error? And if it's not a policy error, is it just a cooling off in some of the activity? Can we get a shallower cycle? That's what I guess the Fed's hoping for.
Amazing to think we've got economists, Lisa, forecasting 4% GDP growth, and there is this conversation happening to the side.
Of recession?
About end of cycles.
Yeah. And Danny Blanchflower is actually leading that conversation.
Danny's going to join us on Wednesday.
Good.
Looking forward to that.
Too.
I knew you'd be excited.
I know.
I did that one for you.
Thank you.
Anytime. Equity futures up 0.4% from New York. Am I getting bullied today?
You are not getting bullied. No,
Just a bit.
No.
A bit.
It's good to have you back.
The 700th anniversary of Dante Alighieri's death has triggered the work of many institutions and offered a very rich schedule of events. Today in Santa Croce, we present one of these projects that suffered a difficult start because COVID-19 has stopped the project that was shared by the Opera di Santi Croce by the Franciscan community from Florence Municipality and the Fund for Religious Building of the Internal Minister. Today, Felice Limosani's project is finally enjoyable. In the Pazzi Chapel, the marvelous architecture by Filippo Brunelleschi, the most important images from the Divine Comedy created by the French illustrator Gustave Doré. Through these images, we can live the violent emotions of hell, the weight of purgatory, and the sublime joy of paradise.
The digital humanities are a cultural occasion to exploit. Summing up, it's about merging humanistic disciplines with new technologies. I find this to be an innovating and modern tool to update culture. Cultural heritage becomes something to hand over to the new generations and not to be put aside. So it's about using technology, pixels, and binary code with a human and humanizing content.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer. This week, find out how Harmeet Singh is spearheading Levi's investments in innovation.
As CFO, the one important thing is to ensure you're able to connect the dots and always think longer term.
Watch the world premiere of Chief Future Officer this Wednesday on Bloomberg.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
market is certainly testing the limits of the central banks.
I'm hearing a lot about this fiscal tightening, and I'm not sure I buy it.
Right now, the bond market is being pushed and pulled between what do I believe?
Supply chain disruptions, higher employment costs are all good problems to have.
There's more purchasing power for the consumer, but it also tells us that there's more inflationary pressure.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
New month, same old story from New York City this morning. Good morning for our audience worldwide, live on TV and radio, alongside Lisa Abramowitz. I'm Jonathan Farrow. TK back with us tomorrow. Katie Lyons helping us out this morning. Your equity market up 19 on the S&P, advancing 0.4%. Lisa, we keep grinding them out, all-time highs.
Yeah, and you have to ask why, right? Yes, it has been earnings, but you rightly pointed to Amazon's earnings, which were highly disappointing. You talk about Apple, disappointing, supply chain disruptions there. People look past it. They say, it's just deferred. How long can we do that for?
It wasn't just that they were disappointing, it was the reasons why they were disappointing. Lisa, they were the two hot button issues at the moment.
I know.
Apple on supply chain, Amazon on labor costs.
I know. And the idea,
unreal.
I know, and the idea that labor costs in particular are only going to continue to get worse, and some people expect supply chain disruptions to only get worse from here as well. So how do people look past all of this to a new era and then factor in that rates are going to remain low forever?
If
That's
they
basically
do
what it is.
remain low forever. Katie Lyons, it's central banks over to you this week.
Yeah, I mean, you have the RBA, the BOE, the Fed all coming this week. And the question is, the BOE maybe could be a live meeting. We could actually see a rate hike. But for the Fed, the hike's not what's on the table. Tapering, yes, that's largely baked in. But what kind of language do we get out of Chairman Powell? And does he push back at all on this market? Or does he kind of let this pulling forward of rate hike expectations sit and not push back on it whatsoever?
It's all going to come down to his assessment of inflation and the path forward. And Lisa, once he explains all of that, we'll work out the rest. There's the what next for this market. It always is. And this was always the risk around the taper story and rate guidance. They were trying to say the rate story is distinct and separate from whatever we say about tapering, except for market participants, it's always about what next. Thank you. Thank you, what's next? And that's the story again this coming Wednesday. We know the taper story's done. The way they've explained it, it sounds like it's on autopilot. Ton of questions on that, I think, and they should be asked. Lisa, beyond that, what's next?
And then what's next after that? I mean, let's say, as you said, Jay Powell does not push back. Do rates go even higher, or do people just basically stay where they are? Or do they basically people price in more rate hikes in this particular cycle, given the fact that fundamentals are so good at this point, John? I don't know.
If you're not familiar with financial markets and you just tuned in accidentally, welcome. Such a childish game. We're pushing the boundaries of the rates market. Equity futures up 18 on the S&P. Stick with us, it gets better. Up 0.4%. Not really. Yields are higher by 2 or 3 basis points on 10s to 158. In the FX market, 115.72. In the commodity market, crude 83.92, up 0.4%. And Lisa, it's a big week for a climate change summit over in Glasgow, Scotland. At the same time, they're leaning on oil producers to pump more oil.
I love this story. It's absolutely amazing. And the oil producers are the ones pushing back, saying, actually, I don't think we need it, and are sort of taking the high road, while all these people who are suddenly climate conscious are saying, we need more oil, please give us more oil. I mean, this sort of highlights the inflationary dynamic and how much this is pressuring the political moment right now.
The irony of the moment, not lost on the president either, and we touched on it earlier this morning. The president's aware of this. He talked about it in Rome. He wants to try and prove that democracies are the best way forward for global prosperity. This is a fantastic example of the struggle to achieve long-term collective goals that are overwhelmed by short-term political cycles, because that number, 84, threatening to go to 90 and more, the price of gas in this country, Lisa, that is very much at the epicenter of a short-term political cycle.
And this is, to me, what's going on with some of the compromises that we're hearing as well, that the Democrats are trying to come to get something passed, and potentially we could get a vote on that later this week. Again, though, how does that get priced into a market?
Joining us on this market, Lisa Hornby, head of US multi-sector fixed income at Schroders. Lisa, we heard from Tony Dwyer in the past week, and he talked about credit holding up. So long as credit holds up, equities will be okay. Have you been surprised by how well insulated credit has been despite everything going on around us?
Yeah, actually, I have been a little bit. You know, you would think that some of this rates volatility would have filtered into equity and credit and risk markets more broadly, but so far it's been pretty resilient. You know, I guess for us, the thing that we're looking at the most closely is, at least for U.S. fixed income markets, the the impact on foreign and overseas demand. I mean, that's something that we've become very reliant on over the past years. There's been a tremendous amount of yield buying just by European, Japanese, Asian-based investors. And to the extent we start to see front-end yields move higher, which impacts the cost of their hedging their currencies, that could eventually have some impact on their demand for U.S. credit product. So far, we're not seeing much of a change in that front, and so we've seen really credit spreads be quite resilient. Our expectation is that we will get a little bit more volatility in the coming months, particularly as we get some of these central bank moves out of the way, and we see, how markets can actually stand on their own without the huge liquidity that we've had provided to us over the last 18 months or so.
Lisa, I'm going to live up to my reputation as Dr. Gloom, because I keep thinking about what happens when the Fed starts hiking. What happens when we get to the end of this cycle? What does the end of this credit cycle look like?
I think the end of this credit cycle probably looks like the end of most credit cycles, right? You start to see leverage increase. You start to see some of the same phenomena we've seen in the past. For us, we tend to use spreads as our guide, right? When spreads get almost insanely tight, and I could almost say we're close to that point now.
But forgive me, Lisa, I'm sorry for breaking in here, but it's not just what do you look for, but what's the nature of defaults at a time when the Federal Reserve has gotten a reputation of stepping in?
Well, that's a good question. I guess your question is the Fed allowing a credit cycle to exist anymore? And I don't know, frankly, we don't know the answer to that. I think markets are still going to behave like it will exist, but what you saw this past crisis, and probably what's to come in the future, is that those bounces low to the absolute, low in credit spreads to the peak and then back, become shorter in nature because the markets start to discount a very quick and rapid central bank response.
Yeah, well, Lisa, I was speaking with Steen Jacobson over at Saxo Bank earlier today, and he basically said that. He said central banks are so far behind the curve on inflation that they are going to have to act more quickly. The hiking cycle is going to be shorter, and it actually might result in them having to loosen policy again earlier because of a kind of overreaction. What's your reaction to that?
I mean, Look, I think central banks are always behind markets. You're seeing that today, right? It's the central banks that are catching up to what the market has done in terms of pricing, at least in the U.S. So I think that's probably spot on. Central banks are going to respond. They're trying to respond on a number of fronts. I mean, Powell has a very difficult message to walk ahead of himself this week, right? He can't be too benign on inflation. Otherwise, you're going to have the bond market vigilantes sort of pushing that narrative. At the same time, the market has undergone quite a significant front-end repricing. You cannot, you don't want to see a situation where the market starts to kind of go crazy on that front, and Powell endorses it. So I think all of these central bankers are kind of in for a difficult messaging over the next couple of years, really, as this inflation narrative is, in our view, not quite as transitory as people have made it out to be, and that's probably a more structural trend rather than a very short-term one.
Lisa, just quickly, there must be some weakness somewhere that you're just nibbling at, thinking about buying. I'm looking at Italian 10s right now, up 10, 11 basis points over in Italy to about 127. This is a world where there is a struggle to get yield, a world where central banks will have some limitations on how far they can push the policy rate. Does 127 in Italy get it done? Do you sit out and wait for more? What is it, Lisa?
We're not quite there yet on Italy. I know you love to ask me about that one. But I will say that emerging markets are starting to open up as an opportunity for us. I mean, we have seen pretty dramatic underperformance in some of the EM names. And in our view, there are some opportunities there. We'd like to get a little bit of stability in the dollar to give us a bit more confidence in taking some of that trade. But certainly there are emerging market issuers that have underperformed. And those that are geared to the U.S. economic recovery, we're a bit more favorable on those. We are starting to take advantage of some of the opportunities there.
Interesting. Come on when you're buying a little bit more and we can talk more about it. Lisa, thank you. Lisa Hornby of Schroders takes us immediately to the China conversation.
Yes.
We started with Amazon and Apple. What you heard from Amazon was an issue with labor costs. For my read on the economy, I don't really care if Amazon is finding it costly to meet up with demand. At least that's not my problem. It's theirs, and for anyone that's got exposure to the stock, which is basically everyone because it's in the S&P 500. Put that to one side. I don't see a problem with demand. with Apple, you heard it from Tim Cook himself. He talked about robust, very robust demand. With China, you see something different, Lisa, and that's the point Diane Swank of Grant Thornton is making out on Twitter this morning. With China, you see a demand issue.
A demand issue as they have a zero COVID policy, and that continues to come into effect again and again. We saw these data points out of China over the weekend. I really think that this is a massive story. We saw ongoing weakening and actually started to see producers pass along price hikes to consumers. We hadn't seen that before, and you see that price index inflation has actually risen to the most since the early 1990s. How does this bleed into their economy, which is the second biggest in the world?
Do you think the EM China space is a little bit more interesting right now, away from this story with the Fed, away from rates tapering?
Well, I mean, I think it's interesting. I don't want interesting to mean that I'm going to buy it because I'm not going to recommend a trade. But I also think that, people are looking at companies that are being allowed to fail for the first time, which really is a new thing for China. Some people saying this is a good thing. Perhaps this means more free markets.
Kelly Lyons, your thoughts?
Well, for me, the interesting part of the China data is the fact that you see that the power crunch in particular is biting. And that comes back to the coal conversation, and why COP26 is going to be so difficult is because China's telling coal producers, hey, produce as much as you can. We got a power. They're worried about the domestic economy and shoring up the support for the Communist Party. They're less worried about, making an international agreement on climate change.
Just a cheat guide for this program. Lisa only highlights things to sell, not to buy.
True story.
Up 17 on the S&P.
I'm going to own that.
0.4%. Apparently, no journalistic integrity if you recommend things to buy, but highlighting things to sell.
Well, highlighting potential problem spots to look around corners.
Downside risk, I get it. Futures up 17, advancing 0.4% from New York.
John.
This is Bloomberg.
With the First Word News, I'm Laura Wright. There's a change at the top of Barclays. CEO Jeff Staley is stepping down in the midst of an investigation into how he characterized his ties to the late financier and sex offender Jeffrey Epstein. On Friday, Staley and the British Bank received UK regulators' preliminary conclusions. Barclays says Staley intends to contest the findings. Barclays will replace Staley with the head of its markets division, C.S. Venkatakrishnan. The US and European Union have reached a tariff-busting trade agreement to fix the steel and aluminium markets. They'll try to leverage it into a broader global arrangement that would penalize countries that don't meet low-carbon targets when producing the metals. The accord will remove tariffs on as much as $10 billion of goods. An offer from the world's richest person, Elon Musk. He tells the United Nations that if it can prove he can solve world hunger, he will sell some of his Tesla stock. The head of the UN's World Food Programme has called on Musk and Amazon co-founder Jeff Bezos to come up with $6 billion. He says that could keep 42 million people from dying. President Biden joins other world leaders in Scotland today for the start of the United Nations Climate Change Summit, but he's there without the signed and sealed agreement he was counting on from Congress to quiet skeptics of the US commitment. The president has a handshake deal with lawmakers to spend $555 billion fighting global warming. Still, what he's bringing to the summit is a message of trust us. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg.
City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics?
China is a gigantic part of our economic life and will be for a long time, for our lifetimes. But what that does not mean that we should be naive in the way that we look at our critical national infrastructure, the way we look at, you mentioned nuclear power, you mentioned 5G technology. Those are all legitimate concerns that any government, many other governments around the world have. But I want to be, I've said this many times, it's worth repeating, I am no Sinophobe, very far from it. I think.
Do you think you're the last Sinophile in the cabinet?
No, I expect there are lots of. Look, China is a great country and civilization.
What about wind power? Would you let them buy offshore wind power? That's infrastructure.
I think you'd have to
railways.
You'd have to look at you'd have to look at what was you're defining as strategic or critical.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Do you see Deutsche Bank ready to pay more and pay out more in terms of bonuses for staff to have that strong talent that I'm sure you want?
Well, look, it's a war for talent. It has been, in other cycles before. It is now. We're finding that we're competitive in that war for talent.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
I think the Fed wants to run the economy hot. They want to get the labor market back to where it was before COVID, and they're going to take a lot of persuading that they need to raise rates aggressively and earlier. I do think the next few months are going to be really tough.
That was Ian Shepperton there of Pantheon Macroeconomics, the founder and chief economist. Really tough few months ahead, maybe. Some people, Lisa, think this labour market is already hot after that data point we got at the back end of last week.
And it's not the only one. I mean, we've gotten other data points also that suggest it. And I honestly think that if we get a disappointment in the number of jobs that we get on Friday, how much do people start talking about a tight labor market, that people are not coming back in, especially if the participation rate does not increase?
450, the estimate gone into payrolls Friday from New York this morning. Good morning. Here's the price action for you this Monday morning. Up 17, advancing 0.4%. All-time highs at a close on Friday. We add some weight to that rally this morning. Yields up 3 basis points to 158.56. Going into the RBA overnight, the Federal Reserve on Wednesday, and then on to the Bank of England. We're told it's live on Thursday, a live meeting. Lisa,
you think it's not? Why do you think it's not live?
Hugh Hill of the Bank of England said it's live. Anyone that's followed this Bank of England for the last 10 years, when they get this initial rate guidance, they have a healthy degree of skepticism about whether to really buy into it. Just saying that.
But don't you think the market's buying into it?
They won't hike, they will hike. I'm just saying that for a lot of people that followed this Bank of England, they used to call Mark Carney, the former governor of the Bank of England, who was on this program a few hours ago, the unreliable boyfriend on Threadneedle Street. People are still haunted by that. 2014, he did this Mansion House address, this nice little speech, and talked about maybe interest rates rising in the future, alluded to that point, and then it just didn't come. Didn't happen. Took years to happen. So that's the reason
I think
why.
that's good. You did a great job.
Thank you.
That's fair.
Thank you very much. I once asked him at a news conference why he was so obsessed with that first rate hike, and he said, "You are," and shut me down very quickly. And he was right. I was.
And
joining
the
us now is
continued.
Yes. We've made up since. Greg Vanier joins us now, Chief U.S. Policy Strategist at AGF Investments. Greg, on a deal down in Washington, you've said before, You don't think it can happen anytime soon. You think it's coming soon now. What's changed, Greg?
In a word, Virginia. I think a lot of Democrats are worried they're going to lose in Virginia on Tuesday night, and that really shortens the amount of time in which they can get stuff done. So I think this has put additional pressure on. But plus, I think a lot of the key issues have finally been resolved.
Greg, let's talk about Virginia then and build on that conversation. We characterized it earlier as a really peculiar moment where one candidate is making this a referendum on the current president and the other one is making it a referendum on the former president. And what's really intriguing to me, just following the news, watching the various news stations here in America, they never talk about who Glenn Youngkin is, his background on Wall Street, Carlyle. Greg, it never comes up. Why is that?
Well, his initial ads were all about how he played college basketball, and his initial ads were, as an ordinary guy, but he's worth hundreds of millions of dollars. Frankly, I don't know why. I think it's maybe because Terry McAuliffe's worth a lot of money as well.
Greg, when you say that there seems to be some progress with the Democrats, who's capitulating? The progressives? The moderates? Yeah, I think the progressives, they're furious with Manchin and Sinema, but I think they now realize they better take something because it's possible they could get nothing. And I think that's changed their whole attitude. How much is that perhaps what was behind Treasury Secretary Janet Yellen coming out and conceding what might have been obvious to some people, that the Democrats might have to go it alone when it comes to raising the debt ceiling? Is this now sort of because there's enough consensus among Democrats to get reconciliation done? I think so, but there's a sleeper here, Lisa, and that sleeper is it's possible we won't hit the debt ceiling in early December. Receipts have been fabulous. Revenues to Treasury have been great. It's possible she might be able to wait until February before we have to raise the debt ceiling. So that's changed things as well. But in the final analysis, that's correct. The Democrats are going to have to do it themselves.
So all of this is going on domestically, Greg, at the same time that the president is abroad. He left Rome. He is now in Glasgow for COP26. When he speaks later on this morning, is he speaking to Russia and China, those that aren't at COP26? Is he speaking more broadly to the international community, or is even this targeted toward his domestic constituency at home?
The latter. I think he is under real pressure to come up with a victory. His polling slump has been quite extraordinary, as you know. He's down now in the low 40s. So he needs to do something. I think the visit with the Pope may have given him a couple of points, but he needs to do something today that's aimed at a domestic U.S. audience more than any other.
And bringing it back to the race in Virginia, is the loss for Terry McAuliffe going to be blamed on President Biden and President Biden only?
Well, this failure will have a lot of fathers. This defeat, if it is, I think you can blame crime, you can blame the immigration story, you certainly can blame inflation, but the sleeper issue may not be appreciated around the country. But here, since I get like 8 million ads a day on TV for both candidates, the real issue is what teachers should teach kids. Should teachers talk about controversial racial issues? Should teachers talk about other things that perhaps parents don't want their kids to know about? And Terry McAuliffe has acted in kind of a tone-deaf way, kind of arrogant, saying, I don't think we should tell teachers what they should be teaching our kids. No, most people in Virginia say you should tell teachers. I'm agnostic on this, but I say as a political analyst, this has really hurt Terry McAuliffe, who didn't get it.
Well, Greg, as a political analyst, this is the issue right now, isn't it? We're taking the temperature of how far the Democratic Party can push things to the left. Isn't that why this is such a big test?
Absolutely. And this could be a repudiation to the progressives, who haven't had a great year to begin with. It sends a tremendous message, canary in the coal mine, for next fall. I think the Republicans regain the House, and I think they have a chance to take the Senate as well.
Greg Valliere, thank you, sir, of AGF Investments. It's a real test, a real temperature test coming up in the next 24 hours, Lisa, and whether it clips the wings of the progressives going into the midterms next year.
Or whether it already has, right? I mean, if they're capitulating on a lot of their different agenda points because they don't think that they're going to get anything if they don't, it tells you a lot about the political temperature right now.
Greg seems to think they have, doesn't he? Did you get that impression from him just then?
Well, I mean, look, it came down to Manchin. Joe Manchin has been driving the ship when it comes to the headline numbers and when it comes to the tax proposal. I mean, you had Senator Sinema setting out her proposal, what she'd be okay with respect to taxes. And that seems to be what was adapted within the new legislation. We'll see it, though.
Or President Manchin, as he has been called at times over the last several months. The actual president of the United States is in Glasgow, Scotland. He has just turned up at the event campus in Glasgow, Scotland for the COP26 summit, a climate change conference with the UN. We will hear from the President of the United States at some point in the 9 o'clock hour. So at 9 o'clock Eastern time, what we'll get is the President of the United States and several other leaders delivering statements, Lee. So the President third in line. We're getting pictures of Prince Charles right now as well in Glasgow, Scotland.
Who are they speaking to? And at a certain point, fluff statements don't work. We have been doing this for long enough that people want something a little more concrete.
Do you think we get more fluff this week?
Yes. Do you?
I don't have a view on these things.
Oh, come on. Yes, you do.
I do not.
Come on.
What an accusation.
You think that you're going to hear a lot of something that rhymes with fluff?
With no agenda. Equity futures up 17, up 0.4% from New York. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Crypto, you have a world of young people that want their own financial system and their own culture. And It is very powerful, and I'm a big believer in it.
Live from New York City on radio and TV, this is Bloomberg Surveillance. Alongside Lisa Abramowitz, I'm Jonathan Ferro. Katie Lyons in for Tom Keene this morning. TK back tomorrow. Your equity market up 17 on the S&P, advancing 0.4%. All-time highs at the close on Friday. 4 weeks of gains, a monthly gain, the biggest monthly gain going back to November 20. November 2020 was a massive month of gains. We were up almost 7 percentage points last month alone. Just unreal. Yields up 2 or 3 basis points. Call it 3. 158.21 on 10s. Yields are higher by about a basis point at the front end through much of this morning, on 2s through about 50 basis points. Crude $84 a barrel, up 50 cents on a session. We're up 0.6%. It's all about one thing this week for the Federal Reserve. Give us your rate guidance. Joining us now is Andrew Hollenhorst, Chief U.S. Economist at Citi Global Markets. Now, Mr. Hollenhorst, you had some forecast out at the start of this year for rate hikes from the Fed to start next year in December. As you've indicated, people thought you were hawkish, so they're now accusing you of being a dove.
That's right. Yeah, that's definitely been the evolution. When we came into the year with that forecast, people actually asked us, did you put the wrong year behind December? Should it be December 2023? Should it be December 2024? But no, it was 2022, and we're still in December 2022, even as we see the market is starting to move ahead of us here.
So this is the ultimate win for a strategist, right? This means that you are early and potentially late, but probably dead on. What gave you conviction before, and what gives you conviction now that they're not going to hike more than just once next year?
You know, I don't know if conviction is really the word that I can use, but the single thing that we were looking at was the rapid recovery in demand and what that would mean for inflation. And really, it's the inflation story that matters. And that's why I say it's hard to say conviction, because inflation has been a difficult variable for any macroeconomist to get right, for any policymaker to get right. But when we came into the year looking at the numbers, it looked like that strong demand was going to be there. That could drive some stronger inflation. I think that's what we're seeing coming through in the data now. And when we see the market moving these rate hikes earlier, when we see some calls that are thinking about the Fed hiking earlier, I think it's really about that inflation story, what we're seeing in shelter prices, what we're seeing in services. We know it's there in goods. The question is, does it broaden now? Does it become more persistent? Does it stay with us? And does that cause the Fed to hike?
Let's look past Wednesday to Friday, to the payrolls report that we're going to get. If we get a low surprise, a negative surprise, downside surprise, what does that mean in terms of tightness for this labor market?
It's so interesting because we were so focused on the headline jobs number because the Fed told us substantial further progress in the labor market. That's what we needed to see to get to the taper. Well, we're to the taper now. We think that at the FOMC meeting this week, we'll have an announcement of the tapering of $120 billion a month of asset purchases. So the focus is no longer so much on that headline jobs number. Now the focus is there a shortage of workers in the labor market? So you can have a weak reading in a jobs report because there's no demand for jobs. If we get a weak reading, I think it's going to be driven by the fact that there's not the supply of workers there behind it. So we're really looking at data on wages. We're looking at data on participation. It's that shortage story that matters more than the particular headline jobs number.
Okay, so let's focus in on participation, which has stayed stubbornly low around that 61% level. Is that structural now?
It looks like at least a piece of it is structural. I think where we can most clearly say there's probably a structural element is with those 55 and over. Somewhere between 500,000 and 1 million workers, we think, have dropped out of the labor force, which are really early retirements, right? This was, you had excess savings during the pandemic period, maybe lost some attachment to a job. And now that retirement, which was 5 years, 10 years off, it came early. And so those workers are probably permanently out. What we're watching on a month-to-month basis is the prime age workers. Are you seeing those prime age workers coming back in or staying out? And I think that's where the surprise has been, especially relative to policymaker expectations. You know, there was a view at the Fed that enhanced unemployment benefits were going to expire, schools were going to reopen, and you'd have really a surge of workers coming back into the labor force. And I think it's clear now in the data that we're not seeing that surge of workers. The question now is there going to be a trickle of workers that's slowly coming in and relieving some of the worker shortage that we're seeing? Or is this really structural? People have just re-examined their lives, made a different life plan, and working for some people is not part of that now.
Well, Andrew, you mentioned excess savings during the course of the pandemic, and that brings me back to the note out of Mike Wilson and the team at Morgan Stanley this morning. His whole thesis is that the bull run in equities can't last for much longer. But what's interesting is he points to a payback in demand early next year, in that a lot of that excess savings is now back to pre-pandemic levels. Inflation is starting to bite for some of those lower-end consumers, and you're going to see a year-over-year decline in personal disposable income. At what point are you worried about the consumer's propensity and willingness to spend and to be tolerant of the higher prices that companies are trying to pass through?
Yeah, great question. And I think I get worried about it when I think about late 2022. If I look at early 2022, then the story that you mentioned, the pent-up demand, supply that just hasn't satisfied that demand. If you look at autos, for instance, running 12 million, 13 million annualized auto sales a month, that number should be 16 or 17 million. Those people still want to buy cars, and as soon as that production ramps up, we're going to see those auto sales. So it's hard to get too negative on the first half of 2022. When you look at the second half of 2022, that's when you think about, have we worked through some of those savings that have been pent up, that are ready to come out and become demand? Are we seeing higher prices that are now outstripping the rises that we're seeing in wages? So wages are accelerating, but prices, of course, are also rising rapidly. And that means real incomes are actually declining. So that's, it's part of the demand story. It's also part of the inflation story. Does that become a little bit of a spiral where we see prices and wages rising together? Or does this actually become something that's negative for demand, where prices are moving too much ahead of wages?
And this really goes to the idea that people in the market tend to be impatient, which is probably why I enjoy covering them, because I relate deeply. But this idea that once we get a sense of when the Fed will hike, we look to what's next, how many more times, what's the pace of rate hikes going to look like, what is the end of the cycle going to look like, and you take it on from there. Andrew Hollenhorst, Chief U.S. Economist of Citigroup, what is your view here about the path of this rate hiking cycle? The idea that if the Fed hikes sooner, they cannot go for that long, and it will be a shorter cycle.
I think in terms of where they get to, in terms of a terminal rate, right now it looks like maybe that terminal rate is not going to be that high. If you look at the last hiking cycle, you only really got real rates up to about 100 basis points, which means that nominal rates really shouldn't be going much past 2 to 3%. And then you think about where rates came back down to, real rates ended up around 0 basis points, which would be nominal rates around 2%. So the destination, I think, is not too high, or at least will be viewed as not too high. On the other hand, remember, we're in a flexible average inflation targeting regime. What does that mean? It means that you allow inflation to overshoot before you start raising rates. It means that when you start raising rates, you should have a lot of confidence about proceeding with rate hikes. So even though the destination is not too far away, I think the Fed will be relatively deliberate about raising rates. One rate hike every quarter, so about 4 rate hikes a year, maybe only getting up to around 2% nominal rates. But still, I wouldn't expect that this is kind of, 1 or 2 rate hikes and you're done.
All right, so that's all on the monetary policy side, Andrew. On the fiscal policy side, maybe we could actually see some action down on Capitol Hill this week as it relates to the infrastructure package and the social spending package. But both of those are a lot smaller in size and scope than originally intended. Net, when you look at a package that is smaller, but also maybe, the revenue, the pay for kind of side that is also more moderate than expected, how does that inform your thesis for what the economy is going to look like over the next 5-10 years?
Yeah, I think it's a really difficult question over 5 or 10 years. And remember that some of the elements of this fiscal package, even if they're initially legislated for 1 or 2 years, take the enhanced child tax credit as an example, for instance, if that becomes popular, then it may stay part of legislation even beyond the period when it's meant to expire, according to this particular fiscal package. So when we actually project these things out, we don't just take current law as what will happen. We actually make assumptions about things like a child tax credit being continued. So I think what you're likely to see here is spending that exceeds revenue. There's still a lot of questions about the revenue side. In any case, it will be spending that's more front-loaded relative to revenue. So we'll have things like a corporate tax, maybe a 15% minimum corporate tax. That's going to extend out for 10 years, whereas the spending, enhanced child tax credit, for instance, that's going to be front-loaded in the first couple years. So I think we're looking at larger deficits. I think we're looking at net positive fiscal impulse, but relative to a hugely positive fiscal impulse over the last couple years. So that's really what the economy has to navigate here, is coming from direct transfers on the order of trillions of dollars to individuals, to now we're talking about hundreds of billions going forward.
Andrew, you're too dovish. Go away. Just going to catch up. Thank you. Andrew Holland, obviously good to see you. Johnny Guest from Citi.
Come soon.
Lisa, this must be so frustrating that you deliver that kind of forecast. The market goes above and beyond what you were looking for, and then everyone starts calling you dovish because you were hawkish at the start of the year.
I think it's victory. I think actually what it means is you feel like you're standing in the right because people can't get it right. Yeah. Honestly, this just shows how much the market has moved around a single forecast.
We're seeing a lot of houses, Kaylee, mark to market over the last couple of weeks.
Yeah, absolutely. I mean, in theory, Jan Hatzius over at Goldman Sachs, who over the weekend put out the note saying that the Fed's going to move in July, is just playing catch up to what the market had already priced in. So you already had the traders in the bond market, the vigilantes, whatever you want to call them, playing this game, and now economists are being forced to catch up to that.
Yeah, hard to call it hawkish for the likes of Jan Hatzius when the market is right there on the money, right there. A little bit later, I'll be catching up with Stuart Kaiser, the head of equity derivatives over at UBS. Looking forward to that conversation on this equity market. Then the coverage continues through the week on central bank decisions, and this right here over in Glasgow, Scotland, the opening session of COP26, the Prime Minister Boris Johnson delivering an opening statement right now, Lisa. Then it's on to the President, who I understand is third in line to deliver his statement. Sometime around 9 Eastern time, we should hear from the President of the United States, though you can tell that my guidance is pretty loose.
I hope that something substantive comes of this. I mean, really, the G20 meeting was a bit disappointing to people because they had some agreements on the headline and sort of ideas, but not on the practicalities of enforcement or details.
Prime Minister Boris Johnson looking for some details today, telling the conference we need to act or it will be too late. We've heard that a lot, haven't we, for a long time?
We have, but where's the urgency? Does that count as fluff or does that count as action?
Is it fluff? You are
I don't know fluff.
Our commander-in-chief when it comes to all things fluff.
Commander-in-fluff.
Is it fluff?
I'll let you carry that conversation forward, John Farrow.
14, up a third of 1% in New York. Good morning. This is Bloomberg.
With the First One News, I'm Laura Wright. The Texas abortion law goes before the U.S. Supreme Court today. It's the strictest in the nation, and it has largely shut down abortion in the country's second largest state. Texas and its allies say a number of legal doctrines prevent federal judges from blocking the law or even entertaining challenges by clinics, doctors, and the Justice Department. Opponents say the law is unconstitutional. Jess Staley is out as CEO of Barclays. He's stepping down in the midst of a British regulatory probe into how he characterized his ties to the late financier and sex offender Jeffrey Epstein. The bank says it was made aware of the preliminary findings on Friday evening and says Staley plans to contest the findings. He'll be replaced by the head of Barclays Markets Division, C.S. Venkatakrishnan. More than 5 million people around the world have died from the coronavirus less than 2 years after it was first documented. Still, the arrival of vaccines has slashed fatality rates. The latest 1 million deaths came slower than the previous two. The death rate has returned to what was seen during the first year of the pandemic when the virus was still taking hold. Europe is starved for natural gas again. Some Russian gas is now flowing eastward from Germany to Poland, reversing the usual direction. And Algeria has stopped shipments to Spain. The result, gas prices in Europe rose the most in 2 weeks today after falling 26% last week. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
Engine number one was able to do on the Exxon fight. It opened a lot of people's eyes to, I guess, the power that smaller investors can have. And I'm curious as to how other people can sort of look at what you did and use that is either a template or maybe just some sort of guide as to how they can sort of approach their relationships with other companies.
We founded the company in Engine number one on the idea that we take the data, not ratings and rankings of ESG of the past, but we actually take the environmental, the climate, the social, worker data, and we simply use it to look at the valuation of companies and look at it over a long period of time. And so if you think about it that way, you own these companies. Everybody that owns the company, whether you're a big institutional investor or you're a small retail investor, you own the company. You have a voice, you have a vote every year. Yeah. And so our approach is to use the vote and engage with these companies over time.
But that's always been the case. I mean, at least in theory.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This week on Bloomberg Television and Radio.
We are on the verge of a disaster.
Join us live from Glasgow for coverage of the COP26 Climate Change Conference.
People are beginning to build some momentum, I think. The question is, will it be enough?
We'll speak with global leaders, keep you up to date on progress and setbacks, and analyze what it all means to you.
We're going to need to see some real action.
COP26, the UN Climate Change Conference. This week on Bloomberg Television and Radio.
The past 18 months have reminded us how essential the PC is to work, life, learning, and connecting. And with Windows 11, we have renewed sense of the role Windows plays in the world. It offers personal agency and real choice to users.
When you have wage growth of this magnitude, especially if it proves to be persistent, you get this wage price push into broader prices, and that sets up for a much more of a sticky path higher of inflation, and the Fed is going to pay very close attention to that.
That was Michelle Meyer, Bank of America chief U.S. economist. Very much in the United States, all the focus is on wage pressure, on inflation. How much is it going up in a way that's sustainable? How much could potentially get out of control? In China, however, the conversation has a cloudier feel to it. You are seeing price increases, and you saw that very much on the manufacturing side. But suddenly, over the weekend, we started to see it passed along to the end consumer, a new phenomenon. Joining us now, myself, as well as, of course, Kaylee Lyons, who is with me, Damian Sassower, Chief Emerging Markets Credit Strategist at Bloomberg Intelligence. Damian, what did you make of this feeling, a sort of souring in the Chinese data yet again over the weekend that showed that these price increases are getting to the end consumer?
No, you're absolutely right. I mean, China is definitely passing through the price increases. We knew that PPI was at the highest in 26 years, but now it's passing through downstream. It's passing into other sectors. And that means CPI is going to rise, and that is definitely not good for an economy that desperately needs liquidity, that needs policy easing. I mean, because basically higher inflation means there's limited scope for the PBOC to continue to cut rates, and that's what we're seeing here. What's interesting is that China's PMI fell while most PMIs across the whole of Asia rose and were stronger over the period, over the month of October. Australia, India, Indonesia, you name it, all had stronger PMIs. So kind of an outlier here that China had weakness.
Well, and we'll get into exactly the idiosyncratic factors, if I dare say them, of China and how they might be affecting other countries in the region. But I just want to hone in on this idea that you talked about, the idea that if inflationary pressures are so prevalent, that's going to tie the hands of the People's Bank of China, how much they can actually ease to try to ignite the economy. And frankly, this is a dilemma seen across the emerging markets complex. How much does that make an issue for an economy that would like to see its growth accelerate just a little bit more?
Well, certainly here at Bloomberg, we're calling for a RRR cut this month. And, I think we're still calling for that, but it's definitely looking bleak, and I don't think we're going to see it. In fact, it looks like the PBOC would much rather resort to liquidity injections via the repo market than actually cutting the RRR rate. So I think, that's kind of becoming the broad consensus now, is that the PBOC is not going to cut rates. And just speaking about those input prices being passed along to companies downstream, we saw that in the profit growth data, which was released last week. Yes, we saw 16.3% year-over-year increase, but, it was all based on metals and mining and processing industries booming, while the downstream sectors, textiles, apparel, struggled.
Damien, does all of this mean that China is going to have to change its COVID zero policy approach?
That's a great question, Kelly. I don't know if they're in position to change it. I think what they are trying to do is help ease the power price crisis, because really it's been these electricity shortages that have really kind of dampened supply and what have you. So, they agreed to cap thermal coal prices. That obviously sent shares of some of the bigger coal producers like China's Shenhua and Yangzhou coal mining down pretty significantly last week. But to your point, the Delta variant outbreak in the north is starting to pass. Yes, they locked down thousands off the back of that, and it certainly hurt them in October during the 7-day National Day holiday. And we're seeing, that's kind of why we saw the Caxton PMI actually rise despite the decline in the official data overnight.
Well, Damien, I'm glad you brought up coal, because we also have to keep in mind that this data was influenced by the power crunch that China is experiencing. And China's response to that has been to turn back to traditional energy sources, to turn back to coal and tell producers not to worry about quotas. And that, of course, comes against the backdrop of COP26 and the pursuit of a world warming less than 1.5 degrees Celsius. How do you think about China's transition and or lack thereof toward renewable energy and what it means for China prioritizing Chinese growth?
Well, just the fact that President Xi wasn't at COP26, I think, tells you everything you need to know. I mean, look, China is definitely turning inward. They are definitely, turning into their domestic economy. If that means they have to produce more coal, consume more coal in order to power their economy, they're definitely going to do that. So I don't really think it's anything different. I think what's really different here, if you want to talk about, clean energy, is the reliance of Europe on Russian dirty gas in order to power itself, right? So talk is cheap, I guess.
Well, Damien, then what do you do with this, right? I mean, basically, does that mean that some of the weakness that we've seen in Chinese debt has more to go, that basically the hands of the PBOC are going to be somewhat tied, and that on an ongoing basis, there's not a lot that the authorities can do?
Well, now you're talking my language, because we're shifting to a very critical month here in November. We've got a lot more coupon payments due just this week. Evergrande owes $83 million. Next week, it's another $150 million as grace periods expire on coupon payments across 3 notes. And Casa, I mean, let's not forget them. Next week, they have another $88 million of coupon payments due across 2 notes. So we're starting to get into that, where things can get really, really ugly, really, really fast. And so, yes, I think, if we're going to see anything out of the PBOC in terms of policy movements, this is going to be the month to do it. It's going to be the property sector that forces their hand.
So meanwhile, Damien, just to wrap up, can China control the insolvency wave among some of these property developers? Because we continue to see some of that weakness continue.
I don't know if controlling is the right word for it. Certainly, they're just trying to mitigate the impact on the broader economy, certainly on the real economy, and they've done a fairly good job of doing that to date. But, you're absolutely right. For them to actually step in and stop the faults, it just doesn't seem like that's on their agenda right now. And so, creditors here in the U.S. who own a lot of those bonds are suffering off the back of that, and I don't see any change in that over the near term.
Interesting. Damien Sassower, thank you so much for being with us, and especially as people look to the emerging markets complex for yield at a time, a very little yield, although more at the front end. You do wonder what the potential risk is here. And Kaylee, this is a new regime in China, and I do wonder how much people are pricing this in and factoring this in to some of their global growth elements, their projections in the near future.
Yeah, I mean, China is a Goliath in terms of the global economy, right? This is the second largest economy in the world, and China has been a growth engine for so long. If that story starts to change, how optimistic can you really be on the global growth picture, especially in emerging markets where in a lot of places central banks have had to tighten because of rampant inflation? China's a heavyweight in the emerging market complex as a whole, so you have to consider the dynamics. As idiosyncratic in China issues may be, it does have ripple effects across the rest of the world.
All right, Kaylee, we're most of the way through this earnings season. I do want to just sort of reset here as we prepare for the opening bell in about 35 minutes and get a sense of what the overall read has been. I mean, from your vantage point, do you think that Amazon and Apple are more the story, or do you think that Microsoft and others are really the stalwarts to sort of represent the narrative?
I think if you ask the broader equity market, Amazon and Apple aren't the story, because markets looked right through that to record highs on Friday. But by and large, earnings have been beating to the upside. More than 80% of companies are topping expectations, and to the tune of 9.6% above expectations when it comes to EPS. So all of those supply side issues we were worried about, the supply chain issues that could have eaten into margins, that isn't really materializing. In fact, you're actually seeing margins expand by and large. So this earnings season has been a lot better, and I think that's why we're coming off of the best month for the S&P 500 going all the way back to November of 2020. I think that's an earnings-driven story.
Yeah, the idea that margins continue to expand is just amazing. Yeah. Coming up on Balance of Power, we get more of a conversation with respect to the political landscape, especially ahead of the Virginia election tomorrow. James Gilmore, former governor of Virginia, will be speaking at noon New York time, 4 p.m. London time, to sort of preview this pivotal race that could give a sense of what we can expect in the midterm elections. Right now, we are poised for more gains. I just want to note that the 2-year yield is now at a new post-March 2020 high, 0.5169%. That's for you, Tom Keene. From New York, this is Bloomberg.
Han profundizado el extractivismo en Argentina con más agronegocio, con más transgénicos, con más agrotóxicos, con más proyectos megamineros. Y ahora, como si fuese poco, han avanzado presentando un proyecto de ley que es la ley de hidrocarburos.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer. This week, find out how Harmeet Singh is spearheading Levi's investments in innovation.
As CFO, the one important thing is to ensure you're able to connect the dots and always think longer term.
Watch the world premiere of Chief Future Officer this Wednesday on Bloomberg.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have to switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Let's get the trading week started. Live from New York for our audience worldwide. Good morning, good morning. Your equity market picking up again. All-time high to the close on Friday. Looking to add some weight to that, up 12, up a third of 1%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, we begin with the big issue. Nothing seems to stick.
You think about where yields are rising.
The higher yield story.
You think about liquidities.
Moving through these price increases.
These supply chain issues.
Take Apple for a second. People are disappointed.
In terms of these labor costs, rising labor costs, it pushes, you get this wage price push into broader prices.
Amazon.
They did disappoint.
Apple and Amazon have disappointed.
It's gonna be a headwind for equities as margins begin to take a hit.
Make no mistake, the system is under pressure.
Given the supply chain issues,
the markets are shaking off a lot of this.
We're at all-time highs on stocks.
All-time.
Joining us now is Academy's Peter Cheer, Stuart Kaiser of UBS, and Julie Beale of Kane Anderson Rudnick. Now, guys, at some point, the President of the United States is going to start speaking in Glasgow, Scotland. When he does, I'm going to have to cut you off, and we're going to have to listen to the President for a little while. Before we get there, Julie, this equity market, everything we throw at it, all-time highs. What do you make of it?
I think people continue to not have places to put capital, and so the equity markets continue to benefit from that. But I do think when you see data that tends to be negative, the market spooks pretty dramatically, and so it's a good time to be in quality and stay in places that are safer. The more cyclical companies, I think, are vulnerable just because valuations are so high.
Stuart Kaiser, it's been amazing just to follow all of this, the build-up in rate pricing. We had Goldman Sachs coming into the weekend. First rate hike for them, July of next year. All of that starting to build up because they see more persistent inflation. Stu, your view on the Fed going into a critical week for the Federal Reserve, the RBA, the Bank of England. Do you think market rate pricing right now is in line with what these central banks are communicating?
It's a great question, Jonathan. I mean, from our perspective, we don't expect the Fed to hike rates probably, until a year after the markets are currently pricing it. So obviously the markets are priced pretty aggressively, but these central banks are pretty savvy. They know what their communication is and how it's going to be taken by the markets. And I think their communication was intentional. And whether they're going to be happy with how far the market takes it is probably a slightly different question, but. I think, what they've done and how they communicated was intentional communication. The market will price it, and if they're not comfortable with it, then I think you'll start to see them kind of walk it back in language. I think most likely they're not 100% comfortable with how aggressively the market has priced it, though, at this point.
Peter Shea, your take on that?
Yeah, I think, this whole concept of TINA still is in play, but I do believe markets are making a mistake right now. I think they've been so conditioned to mean lower long-end rates is good for stocks, that this recent lowering of rates is actually because people are starting to potentially price in a policy mistake and rate hikes, and that would actually be bad for stocks. So I think the algos are still driving the show, but I think there's a risk that reality hits and a more hawkish Fed or something that allows rates at the long end to go higher is actually bad for stocks.
Well, let's talk about the economic data that backs up some of the rate moves. The economic data hasn't been there in a big way. Look into China overnight, another sub 50 PMI over the weekend into this morning. That economy's weaker. This is what Bank of America had to say. Julie, I'd love your thoughts on this. They think the speed bumps are in the rearview mirror. They say the following. High-frequency data suggests a bounce in 4Q. We're forecasting 6% real GDP growth in the fourth quarter. Julie, are you looking for the same bounce?
I don't think so. I mean, I think that we continue to have a persistent headache in COVID. I know we're all tired of talking about COVID, but COVID doesn't care. You're talking about hospitals that are turning away patients right now. So I don't think it's behind us. And I think that has an impact on the consumer. And if the consumer is weakened in a U.S. consumer economy, I don't think you're going to have the same bounce, the same optimism into this 4Q. Last 4Q, at least we had the benefit of the vaccine being announced and people being a lot more enthusiastic. And we don't have that this year, nor do we have stimulus. So I'm pretty concerned that it's not just the supply chain issues, it's more than that.
What are we learning from the earnings? Amazon, over on Friday when they released earnings Thursday afternoon. Apple, another one. Look at them in a pre-market right now. It was amazing for me, Pete, to have those two names produce two hot-button issues. Apple talking about supply chain constraints. Still, this equity market finished at a record high. Amazon talking about labor costs. Still, this market finished at an all-time high. It's interesting to me, Pete, that underlying all of this is not a demand problem. How important is that?
I think it's very important, right? If there is no demand problem, we can continue to go. If rates remain low, we continue to grow. There's money coming in the economy. My real concern is that this demand problem will arise and that we've seen a lot of demand pulled forward as people reacted to these supply chain shortages by accumulating goods sooner than they would have otherwise. So I'm actually thinking we're not going to get a positive bump in Q4. I think we're actually going to see some very disappointing data because I believe so much consumer spending was pulled forward. That's going to be a problem. And the stimulus package, which I was hoping was going to be very positive, seems going to marginal probably at best.
Your thoughts seem to be in line with Judy then. And Stuart, I wonder where you're coming down on this. I'll repeat what I said just before. When you looked at Amazon, it was a story of labor costs. When you looked at Apple, it was a story of supply chains. They weren't talking about weak demand. Even Apple said very robust demand. When you look to China, something different is happening, Stu. I just wonder where you come down on this. Do we start to see that demand problem start to filter through a little bit more?
Look, I mean, tactically speaking, we expect growth data, reported over the next couple of weeks to be very strong. Bigger picture, our view is, our focus is, I think, much less on the demand than it is on the mix of demand. I think a lot of economists, ours included, are looking for kind of this shift from goods into services spend. So I think for us, it's as much about mix as it is about the level of demand. So no, we don't, expect really strong headwinds for demand in the fourth quarter, but we are, acutely focused on the shift from goods into services, which I think will impact not only the rate of growth, but also the rate of inflation, which, we haven't touched on, but I think is, as big an issue as the growth dynamic.
We'll touch on it now, Stu. What are you looking for?
Look, we have inflation peaking kind of end of 1Q, and I think in our view, you do have a period here going into, late 2021 where it could create issues. We have owner's equivalent rent at 50 basis points a month, which is an extremely high number. And I think the Fed and most, inflation watchers kind of expected when this services inflation really started to pick up, that the goods price pressure would have already eased. And the fact is we're getting to pick up on the services side without the goods side easing. So I think a lot of what you're seeing from the inflation side is the sequencing hasn't been how we expected it to be. And, end of 1Q, you could have, CPI on a 6 handle, which is an extremely, extremely high number. So I think, that is an area that we're really focused on.
When I listen to the three of you talk about this, Stu, you're looking for more persistent inflation to potentially have a 6 handle in early next year. Judy and Pete, you're talking about maybe demand starting to come in a little bit weaker. Judy, the Fed's in a rock and a hard place right now, in between, isn't it?
Yeah, it's a very difficult position for them to be in, right, because of their dual mandates in terms of, full employment and moderating inflation. And I think we're not at full employment. We still have a lot of ground to make up. I think something on the order of 8 million jobs. We have very weak labor force participation, which we thought was a function of higher unemployment benefits, but still hasn't really climbed back to the levels we had hoped. So I think it's absolutely true that the mix is important in terms of not just the demand picture, but also the labor picture. If services do pick up the way that we're expecting, and there's no people doing the work, that's another pocket where we have a softness in the economy. So I think for sure the Fed is in a difficult position, right? Because they want to encourage full employment, but inflation really seems to be picking up, and it doesn't seem to be nearly as transitory as we had hoped.
So I hear the concern. I don't see it in the price right now. On the S&P 500 at all-time highs, and looking to add another 0.2% this morning ahead of the opening bell about 22 minutes away. This is the constructive view of looking at the world. I go to one man, Jay Pilosky of TPW, a good friend of this program. This is what he has to say on all of this. Easing bottlenecks set the stage for a synchronized global expansion with above-trend growth and above-average inflation supported by massive inventory restocking, cashed-up consumers, a capex boom, and attendant productivity surge. Peter Cheery goes on to say 3% inflation in return to 3 to 4% real GDP growth seems like a great trade. Pete, hard to disagree with that, but you can't disagree with the idea that that's what we get next year. Is it what we get next year?
I I don't think so. I think these supply bottlenecks are longer lasting than people think, right? I think just like everyone talked about inflation being transitory, I think these supply chain issues are not transitory. They're going to be persistent. Companies are going to have to rethink how they get access to goods. So I don't see a big boom. On the other hand, I don't see a big slowdown or anything like that. I just don't see the stage set for this kind of liftoff type scenario that Jay's talking about.
Peter Cheer, Stuart Kaiser, and Julie Beale sticking with us. The stage is set for the President of the United States over in Glasgow, Scotland. Right now, as COP26 kicks off, we are hearing from the Prince of Wales, Prince Charles. Once that wraps up, we're expecting to hear from the President of the United States. And when we get his statement, the beginning of it, we'll bring that to you right here on this program. Coming up next, President Biden calling out nations after producing a lukewarm climate deal at the G20 summit.
Not only Russia, but China basically didn't show up in terms of any commitments to deal with climate change.
The UN Climate Change Summit kicking off right now.
The energy crisis, there's a lack of drivers. Is there anything that you need to ask authorities to do better, or that your clients want the UK to do better?
I think we're at a moment in time where we're coming out of the pandemic and there are a handful of things going on. I think all over the world there are labor issues that are really a reflection of this transition out of the pandemic. There are supply chain issues. Some of this stuff is transitory. There are some secular trends that we have to watch closely. But I think we're adjusting and dealing with it as anybody else is. And I think leaders here are thinking about it the same way leaders are around the world.
When you look at the UK and, of course, some of these green investments that the UK and the City of London particularly has been really trying to pitch, you've been extremely involved in carbon offsetting. Can London really spearhead that movement?
Well, I think it's important that governments around the world partner with the private sector to try to get capital directed toward innovation in a way that we can accelerate the climate transition. And I want to emphasize it's clearly a transition.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
We made commitments here from across the board, all of us.
There's no question that Canada, along with a number of other countries, would have liked stronger language and stronger commitments on the fight against climate change.
We've decided to put coal behind us.
The science is clear that we need to act now.
You're going to see we've made significant progress, and more has to be done.
I must be clear that if Glasgow fails, then the whole thing fails.
Moreover, all G20 countries will commit to net zero emissions by mid-century.
The irony over the weekend wasn't lost on anybody. At the same time the G20 summit was looking to strike a climate deal, the president was pushing oil producers to pump more oil.
The idea that Russia and Saudi Arabia and other major producers are not going to pump more oil so people can have gasoline to get to and from work, for example, is not right. But and what we're considering doing that, I'm reluctant to say before I have to do it.
Joining us now is Bloomberg's Anne-Marie Jourdain out of Rome, where the G20 summit took place. Anne-Marie, the weekend wasn't lost on you either. Can you reconcile these two issues for us?
Certainly not. And John, it wasn't lost on the president. He said from that podium last night, I was in the room, that it is ironic. At the same time, he's pushing these massive producers like Saudi Arabia and Russia, along with some other consumers, to pump more oil, to try to ease those concerns for consumers at the gasoline pump. He's also pushing for big and bold climate change, aggressive language that we did not see out of the G20 communique. The U.S., Canada, and some others would have really liked to have seen more aggressive language when it came to domestic coal. This is the worst of the fossil fuel polluters. And basically what was said in the communique is, as soon as you possibly can. So no dates given. Also, no target for all of G20 to get to net zero. So it sets up a little bit more of a dismal scene going into COP26. The president himself also said he was disappointed with that climate language. And he blamed Russia, John, and China for not showing up, and not just in a physical sense. He said they did not show up in terms of taking on bold emissions, to cut those emissions. And those are also going to be 2 no-shows at COP26 in Glasgow.
So, Anne-Marie, they all meet for the G20 in Rome, and then they travel 1,500 miles to Glasgow, Scotland, to talk about climate change issues again. A lot of people raising this as an issue. The President of the United States is going to speak imminently. I understand from my team that event is fluid, a little bit delayed, as they always are. The President could be speaking in now about 30 minutes. What's your take on what you expect to hear from him later this morning?
Well, the president, what he's going to do is likely try to explain to world leaders that even though the U.S. says that they're going to do all of these different plans in combating climate change, and they've yet to do it, that it will get done. He wants to make sure to have this confidence amongst world leaders that the U.S. is not just going to talk tough, but they are also going to walk the line. So he's likely going to point to everything that's in his agenda. The problem is, Jonathan, right now, is that his Build Back Better agenda and the hard infrastructure package that does have billions of dollars to green initiatives, subsidies, a new green infrastructure, retrofitting buildings, all of that is still at the moment stalled in Congress. So the president really needs to make sure that the U.S. credibility, that they are going to be able to deliver the goods when it comes to reaching their goals for emission targets by cutting that in half by 2030, that they are able to do it. That's what the president is going to convince. Yep. Also, he's likely going to talk about the need for the developed world to really boost the financing for the developing world that was not part of the Industrial Revolution, that need help and financing to get to those points, alongside the developed world. The problem is that money as well, Jonathan, is going to need the sign-off of Congress.
Anne-Marie, thank you, as always. And once again, over the weekend, it displayed one really important thing that the President of the United States spoke about himself. The short-term political cycle overwhelming the long-term objectives of governments meeting over in Glasgow. Anne-Marie, thank you. We did hear from the President of the United States on the infrastructure package. Take a listen to what he had to say.
You've all believed it wouldn't happen from the very beginning, the moment I announced it, and you always seem amazed when it's alive again. Well, you may turn out to be right. Maybe it won't work, but I believe we'll see by the end of next week at home that it's passed.
Could we get it done this week? Peter Cheer, Stuart Kaiser, Julie Bill still with us. Pete, are you hopeful?
I've been hopeful all year, so I've been slowly deteriorating. I thought we should have had the initial fiscal stimulus done in February. We should have had a bipartisan infrastructure deal in May. As this drags on, we're getting less and less of a package that I think is going to be interesting. And although we talked a lot about some of the green initiatives, my one concern remains that we have these goals and really not a good path to get there. And that's becoming more and more clear, just with the irony of the messages you were talking about. We're begging people to produce oil because we haven't done a good job planning an effective transition. And I think we really need to get to work on that. I'm not seeing that coming out of this package in a way I'd like it. So I'm expecting some disappointment, even if we get a deal.
Does it change anything about your investment decisions, Pete? That's the important question. Put the politics to one side. Does it change anything from your perspective?
Yeah, I've been a big fan of domestic companies. I've been a big fan of small caps. I've liked the cyclicals. I think you got to start pulling back on some of those as we get this potential for slower growth and less spending domestically.
Is it an incremental positive, Julie, that we might achieve something on the debt ceiling? This came from the Washington Post this morning. The lead paragraph read as follows. Secretary Janet Yellen on Sunday said Democrats should be willing to approve a fix to the nation's debt ceiling without GOP support if necessary. Isn't that the issue here, Julie? Are we starting to park some of the incremental headwinds, putting them to one side so we can all just move on? Isn't that a market positive?
I mean, yes, the bar is really low where we're excited about just being able to move past the debt ceiling and being able to pay our bills. I mean, it's like, but I do think net on a net basis, it is a positive, because what we are all craving the most is just clarity, right? I think we can all work within parameters as long as we know what the parameters are. But I think it's an interesting point in terms of should the president and the Democrats be working more on their own, or is the hope for more bipartisan action really still there? I think infrastructure is still a really good opportunity, but I agree, as time goes on, the appeal of it and the size of it and the opportunities around it diminish. Sometimes, Stuart Kaiser, it's not what we do or what policymakers do, it's what they choose not to do because they can't do it. We all thought there would be a corporate tax hike. We were all expecting that to happen. Stu, that's been watered down to a minimum tax hike now. And I just wonder from your perspective if that really is a bit of a tailwind for this market, what we're not getting, not what we are getting.
Yeah, I mean, I think basically what you're saying is if Washington stays out of the way, we're all better off. And, I think we're probably in a situation now where the less we're talking about headlines out of D.C., the better off it is for market. Certainly the tax stuff has been a net positive, but I mean, the devil's in the details with this stuff, right? If you really dig into it, they're paying for, 5 years of spending with 10 years of taxes. So there's a lot of weird stuff going on in all these packages. And I think, by and large, the less we talk about it, the better it is. To be clear here, Stu, that's what you said and not what I'm saying, just to keep me out of trouble. Stu, just on the energy sector, can you give me your thoughts on the energy sector right now? There's a big focus from policymakers. They're leaning on OPEC Plus to try and do something about the 84 handle we see on WTI this morning. Do you think they can do anything about it? Well, I mean, I think, President Biden alluded to that he's having trouble getting Russia and Saudi to play ball. And obviously in the U.S., we've made it a little bit harder to get that quick response energy supply out of Texas and the fracking industry for regulatory and financing reasons. So I think a lot of macro investors are looking at it as risk reward is skewed to the upside for the price of oil. Right now, the way the curve is priced, it's sort of priced that this is a very short-term, bounce in the price of oil. And I think a lot of folks we talk to actually expect that to get pushed out a little further and for oil prices to probably rise further from here. So, it's a challenge, right? Normally, the question is, at what price do you stimulate additional supply? And it certainly feels like today that price is a little bit higher than it has been in the past. You can see everything you just said, Stu, through the contract table on the Bloomberg. I'm looking at it now. This market doesn't quite buy this long-term energy story. Julie, I'd love your thoughts on this, just from a pure stocks perspective right now, a stocks perspective. In this equity market in the US, energy's had a great run. You've talked about what you're uncomfortable with. Are you comfortable there? We're long-term investors, so the cyclicality of most of the oil and gas plays are not really, where we're at. But I do think it's interesting relative to where, many renewables and new exciting energy companies play, the valuation on those relative to, the cyclicals in the oil and gas industry. I think that's pretty fascinating, right? Because there gets to be a point where the mismatch just isn't there. It would be awesome if we could just turn off oil and gas and move to renewables, but we're not anywhere near that place. So I think it's such an interesting dichotomy for us to be here, where we're both begging everyone to do everything they can to set strong targets, but we're also begging for more supply. Not encouraging the investment at home, but begging for more supply abroad. Pete, just a final word on this. You've been pretty focused on this energy transition over the last several years, not just the last 5 minutes. Your final take, please.
Yeah, one thing, when we talk to a lot of our intelligence officers, they talk about the problem where you mirror your behavior in your adversaries. So you put too much of your own views on the adversaries. And I look what's going on with China, Russia, Saudi, and suddenly we're surprised they're not acting as we want them to behave. Well, I think we've got to really take a step back and figure out what do China, Russia, Saudi want in this world and figure out how we deal with that, or else we're not going to get to where we need on climate, on energy. And that's been a big policy mistake, and I think it's something we've got to address and understand that China doesn't have the same goals as us necessarily, and it's naive to think they do. So let's be prepared for that ongoing strategic competition, and that will create a lot of benefits for the U.S. economy over time, and I do think it's going to push domestic manufacturing. So that's an area I continue to like and believe is going to be strong for years to come.
Peter Cheer sticking with us alongside Stuart Kaiser and Julie Bill. Coming up, the morning calls, and later, stocks coming off the biggest month of gains since November 2020. New month, same story, equity futures pushing higher. This is Bloomberg.
its top spot as Asia's busiest airport in 2020 when passenger traffic slumped 88% from 2019. The lack of a domestic market and strict COVID rules have made for a slow recovery, and walking through the airport, the majority of F&B outlets and shops do remain closed. Here in the departure hall, long stretches still remain boarded up in areas where you would typically see throngs of passengers waiting to board their flights to destinations across the world. Only 2 lounges do remain open to travelers, one operated by the Plaza Premium Group and the other by Cathay Pacific, down from the 12 that are usually open here at the airport.
Unfortunately, when COVID had hit, we had closed a lot of our lounges and airport hospitality services. We're cautiously optimistic with the growth.
COVID certainly has forced a rethink of strategy to be nimble in the face of policy uncertainty during the pandemic era.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
This is a week made for people who love macro, without a doubt. So many central bank decisions this week. Some data in the mix. Payrolls Friday coming up too. Equity futures up 0.25% on the S&P. Nicely through 4,600 at the back end of last week. All-time highs, and we're looking to add to them. That's the price action here at the morning calls. First up, Barclays downgrading TripAdvisor to underweight from overweight, forecasting a weaker recovery with users shifting their travel behavior amid more flexible working schedules. Next up, Baird downgrading Bank of America to underperform with a $42 price target, warning of elevated expectations and an unappealing valuation. That stock is up by 0.6%. And finally, Stevens upgrading Starbucks to overweight, 130 price target, expecting the company's wage hikes to fuel increasing market share. We're up there by 0.8%, just a little bit of a bounce. Coming up, the rally riding high into November after recording its biggest monthly gain since November of last year. That conversation next. Your opening bell, the start of a brand new trading week, just around the corner. This is Bloomberg.
The past 18 months have reminded us how essential the PC is to work, life, learning, and connecting. And with Windows 11, we have renewed sense of the role Windows plays in the world. It offers personal agency and real choice to users.
surveillance, the Fed decides. Will the Fed finally announce a date to start a taper? And how long will it last? Will they still view inflation as transitory? Find out Wednesday starting at 1:30 p.m. Eastern on Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
25 seconds away from the opening bell here in New York City this morning. Good morning. All-time highs into Monday morning. We advanced 11 points, up 1/4% on the S&P. On a Russell, the small caps up about 0.5%. On a Nasdaq, a little lift up 21, advancing a little more than 0.1%. That's the price action this morning. There's the opening bell. Switch up the board and get to the bond market. The stage is set for Chairman Powell to push back if he wants to against higher rate hike expectations at the front end of the curve. I stress if he wants to. We'll see if he does. Your 10-year, 159.97, just south of 160, yields up 5 basis points. Outside of that, in foreign exchange, euro stronger, dollar weaker, euro dollar 115.76, up about 0.2% there. That currency pair is positive. Outside of that, looking at crude, 84.70, up by 1.33%. We know what the President of the United States would like to see from OPEC Plus. He wants to see him pump more crude. Will they listen to him? We'll hear from OPEC a little bit later this week. So here's the move on the S&P. Early days, up 0.25%, advancing just a little bit. Top of the pile, energy very much in the mix this morning, up by 1 full percentage point. Bottom of the pile, information technology, so far unchanged. I want to take a look at one stock just to kick things off, and it's American Airlines. And we open up as follows. Intraday, here's the move. We are negative about 0.4%. The news over the weekend that American Airlines had to cancel 1,500 flights, struggling with labor shortages and rising demand, and blaming the weather. This came from the Allied Pilots Association, talking about the months ahead. They said the following: we're very concerned about the upcoming holiday travel season. They're setting up all the dominoes. All it's going to take is the fingertip of Mother Nature to send those tumbling. Peter Cheer with us, Stuart Kaiser, Judy Beale with us too. Judy, we're not talking about vaccine mandates here because the company's not mentioned that. They talked about the weather. And I'm trying to understand from your perspective, for the people getting exposure to these cyclical reopening stories, the airlines, how much of a problem there is going into the holiday season?
I think the labor shortages are a huge problem for them. I mean, especially for large airlines that are operating a hub and spoke model. It's true that if anything happens at the major hubs, it causes major disruption and it ripples out throughout the system. And, Chicago's not really known for having great weather. So I think looking forward, there is a concern because we're getting these kind of spikes in demand that are very, very hard to set up for the airlines in place. And so it could be really bumpy for them. I could see a situation where we have, thousands of people stranded at an airport because of weather, but it's not just weather. It's really just being able to set up their scheduling and work with the labor constraints.
Well, that's the issue, isn't it? They blame the weather, some of the high winds out there. The stock is negative 1.2%. Peter Cheer, we saw this with Southwest over the last month or so as well. If it's about access to labor, I'm trying to understand and just park the policy response, park all the opinion about vaccine mandates. Is that going to make access to labor more or less difficult for this industry in the months ahead?
I think it's difficult for all industries, right? It is hard to get quality labor coming in. And if we do get some infrastructure spending, this is one question I have because I've been a big proponent of it, to create more jobs. Right now, the problem isn't jobs available, it's filling those jobs. So I think this pressure to hire good, high quality labor and retain them, because it's not even just getting them in the door, it's getting to the work for more than a week or 2 weeks is a real issue. And that's, again, everyone keeps talking about some of these supply chains as they're very transitory. I think this is going to take a long time, 6 months, years maybe, to work itself out. So that's why I don't think we're going to get that big growth spurt. There's too many labor issues for everyone, and it's not just the airlines dealing with that.
Yeah, this stock is negative in the first few minutes of trading. We're down 1.3%. Stuart Kaiser, your thoughts on this? I keep going back to where we started, and I think you might have mentioned it. Is it profits deferred, profits delayed, or profits lost? And if we're going into holiday season and you don't have the labor to meet the demand, that's a holiday season lost, isn't it?
Yeah, it definitely could be. I mean, I've been surprised by the number of people I talked to. They're already done with their holiday shopping, though. So, maybe in the end, people have been really smart about this. Look, I think to Julie's point at the beginning, I think this is really, a question of just there's very little margin for error. Whether that's, commodity side, weather side, labor side, everything's so tight that even, the smallest issue can kind of create a cascading effect. And I think, that's the reason that the markets have generally been, pricing a fair amount of volatility and risk kind of 3 to 6 months out, persistently for the last couple of years, because even though things might be good in the moment, you realize that there's, a lot of elasticity that if it gets pushed in the wrong direction, it just creates a cascading of effects on the market, whether that's the economy or whether that's earnings.
4 minutes in, staring down the barrel of all-time highs again, the S&P 500 up a third of 1%, coming off the back of the biggest month of gains since November 2020. We heard from Flowbank's Esty Dweck. Take a listen to what she had to say.
Expectations had come down too far for the third quarter between the Delta variant and supply chain disruptions. There were questions about margins, but the reality is demand is extremely strong. The Delta variant was dealt with quite well. Companies have learned to be adaptable, and it isn't really surprising to see strong earnings.
Kelly Lyons, I'm just staring at the screen and wondering whether to say it or not, because I know you're going to want to. The Dow and 36. If Tom was here, you know he would.
Oh yeah, nice round number. Tom Keene, if you're out there watching, congratulations, put your hat on. But the S&P 500 also is at an all-time high, John, and really saw a rally through the month of October. That was quite remarkable, up nearly 7 percentage points over the course of the month. And what's interesting to me, aside from the superlative that this is the best month since November of last year, is the fact that 5.9% of the 6.9% gain came from October 13th to October 31st. And what day was October 13th, John? That was the day that JP Morgan informally kicked off earnings season. So that's why you can make the argument here that this is primarily an earnings-driven story. And this rally, too, was really broad-based when you look beneath the surface. All 11 of the main sectors in the S&P 500 ended the month in positive territory, and there was no real value or growth kind of tilt. And that discretionary was up 11%, big tech, one of the top 3 performers as well. But you also had the likes of energy up about 10%, and materials making the leaderboard, too. And as for what the picture could look like into this month of November, and through to year end, in the last 5 years in which the S&P 500 was up at least 10% or more by October 31st, we have not had a negative November or December. And of course, we're up more than that this year, a gain of 22% year to date. That's the best January to October performance going all the way back to 2013. And in that year, stocks rose by another 5% through year end. So history would suggest the gains could keep coming, John.
Kelly Lyons, thank you very much. 6 minutes in, more all-time highs to talk about. For any of you following COP26 and the Climate Change Summit in Glasgow, Scotland, we're expecting to hear from the President of the United States at some point, I stress, later this morning. I thought it would be at the top of the hour. It's being delayed by some 30 minutes or so. Right now, you can listen to Prime Minister Mario Draghi of Italy on Live Go on the Bloomberg terminal if you are a Bloomberg subscriber. Back with us for more, Peter Cheer, Stuart Kaiser, Julie Beale. Julie, do you care about where the Dow is? Tom Keene and I have an argument about this periodically, maybe 3, 4, 5 times a quarter. Do you care about the Dow? Does it mean anything to you at 36K?
I mean, for us, we are looking at stocks on an individual basis, but I think the Dow is a good indication of sentiment. And if you think about the average person, it's what they kind of know. So I think the tone that it sets is actually kind of important psychologically for the market. But for us, looking at stocks on an individual basis, trying to find the best quality names, no, not really. So I think it just depends,
Pete, you've got the index that people talk about and the index that people allocate. It's what they say versus what they do, and what they allocate to is the S&P 500. Pete, the S&P 500 all-time highs, but what we can talk about as far as the S&P is concerned is just the concentration of that index. The top holdings, the top weightings rather, Microsoft, Apple, Amazon, Tesla, Alphabet. Pete, I just want to comment from you on Tesla. We're talking about a $1 trillion stock, the 4th biggest weighting in the index, trading like a penny stock. Pete, and I just wonder how you're thinking about that issue at the moment.
Yeah, that is one of the things I'm really struggling with. And when we talk about parallels maybe to what happened in 2000, the fact that Tesla swings by $50 billion of market cap, $100 billion market cap almost every day, it seems highly, highly unusual. And you couple that with the fact that the amount of option premium trading in Tesla has been on some days equal to or greater than the option premium trading on the next 99 stocks and futures contracts combined. So there's this weird behavior. It's very much a betting culture. I think the company's great. They're doing lots of good things, but that behavior just doesn't seem to, bode well for a normal market. It could go a lot higher, it could go lower. That's something I'm watching, and that options-driven activity is somewhat concerning to me.
Stu, can I get your response to that, just on the options activity Pete described?
I guess I'm a little less concerned about it. I mean, we've definitely seen a very large pickup in retail options activity over the last couple of weeks. basically back to the level we were in June ahead of 2Q earnings. Look, certainly it's a large stock. It's also a highly liquid stock with highly liquid options. We've seen a lot of options activity. I think sometimes we forget when we look back at how volatile, let's say, Apple was, 5 or 10 years ago, or some of these other stocks were in the past. I guess my view is there's always a large stock or two in the market that are quite volatile and see a lot of options activity. So I don't know that in historical context Tesla is all that much of a unicorn in that sense. So yeah, I mean, it bears watching because it's a big stock that's highly volatile, but I think the market has dealt with these things in the past, and since it's very liquid, I think that does kind of reduce the impact a little bit.
Stuart, it is unusual though to have a $1 trillion name trade 45% higher in a single month, isn't it?
It is, but I mean, trillion's a nominal number, right? I think you need to look at share of the index, and if you went back historically, I think you'd find other large stocks, that moved a lot. Having been an equity strategist before, people were always calling you up and saying, what would earnings be if you took out this stock or that stock, if you took out the banks, if you took out GE? So, and that's what I mean, just in this sense, I think this is a conversation that happens historically. Certainly $1 trillion is a big number, but I don't know that. I feel like this is an issue that we've sort of had to deal with in the past. I'd rather it be happening in a large, super liquid stock than in the GameStops of the world, which are much smaller and less liquid, much less easy to hedge and things of that nature.
Stu, it's a really good final point with an equity market trading at all-time highs. Julie, I want to give you the final word. We've worked through all these big issues, these broad themes. Can you walk me through the single names that you're comfortable with an equity market at all-time highs?
I continue to be focused on the smaller and mid-cap names. I think a lot of what's happening in big tech is hard to predict, and it gets bounced around quite a bit by the retail markets as well. So for us, we're looking at a company like a Manhattan Associates, which is actually helping companies navigate through the supply chain issues. And you would be shocked by how much of the supply chain is still being managed with spreadsheets. This company helps you get real transparency. Another quality business we like is Duck Creek Technologies, and that one focuses on insurance, helping them modernize so that they can compete against a company like Lemonade. That's where we really see a lot of opportunity, is where, technology companies that are allowing us to come into the modern era.
Julie Bill, always good to catch up with you. Come back soon. Don't be a stranger. Alongside Peter Cheer and Stuart Kaiser. Gents, thank you very much to you too. Coming up on the programme, markets looking ahead to the Fed. Investors seeing a tough balancing act for Chairman Powell.
Central banks are going to respond. They're trying to respond on a number of fronts. I mean, Powell has a very difficult message to walk ahead of himself this week.
A ton of central bank decisions this week. That conversation up next. This is Bloomberg.
City. We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics?
Хорошо подготовлены, насколько это было возможно за столь короткие сроки. Это на самом деле эксперимент. Поэтому мне не хочется употреблять такие слова, как страх, боязнь и все прочее. Мне хочется говорить, что это очень волнительно, но одновременно и радостно, потому что, вы же понимаете, как мало людей вообще там были. А у нас есть возможность полететь в космос, и не просто полететь в космос, а сделать там то, что мы умеем по-настоящему хорошо делать на Земле. Это снять кино.
У нас же экспериментальный во многом этот проект. Поэтому мы сейчас
сейчас столкнемся с кинематографическими нюансами, которые мы могли предвидеть отчасти, какие-то, наверное, не могли предвидеть. То есть, несмотря даже на то, что, опять же, все делились с нами там космическим опытом и так далее. Но это опыт, это первый раз. Ну, то есть второй будет проще.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From the RBA, we need to see that they're going to basically kind of reassure markets. From the Fed, we're pretty much the consensus is that the Fed will announce tapering. Finally, with the BOE this week, the expectation seems to be that we will get the first rate hike.
Another busy week for central bankers. 3 days, 3 notable rate decisions. The RBA kicking things off on Tuesday, followed by the Fed on Wednesday. And we are told it's a live meeting on Thursday for the Bank of England. We're told that by the Bank of England chief economist, Hugh Pill. Joining us now for more is Bloomberg's Mike McKee. Morning, Mike.
Good morning, John. Before we get to the central banks, one bit of breaking economic news and disappointment, perhaps for the markets. The market, U.S. manufacturing PMI comes in at 58.4. That's down from 59.2 in the prior month, and it is down below the 59.2 that was expected for this October number. And the issue is, at this point, what does that mean for the ISM coming up at the top of the hour? We're expecting a slight decline, but still over 60. And we'll see if all of the supply chain issues are hurting manufacturers here in the U.S. Now let's talk about the central banks. You're right. We have a big week.
Traders, hello. How are you doing today in a Monday afternoon? I'm going to place an order to buy euro. The price I'm looking to buy 115.73.3. If you look into trade, if you look into copy my trade, please do so. This is the price at 115.73.3. I'm looking to buy. Okay, let's see if we'll be able to execute this order. Okay, guys, stay safe. I'll speak to you later.
So we are starting to see the big battleship of interest rates around the world slowly start to turn. Now let's take a look at that RBA. Here's why they are likely to move, analysts say. They have been practicing yield curve control, promising where the yield is going to be. But on Friday, look what happened to the 2-year note there. It burst through yield curve control, and the RBA did not defend it. So the expectation is they might be raising rates or at least getting rid of yield curve control as a policy. And then we take a look at the Fed. The Fed is going to taper. We know that. And so we kind of put that out of mind. And we start on Thursday morning with John Show asking, when do they raise rates? You can see the market there. They're already pricing in. That's the current OIS rate increase, at least one for 2022. And so that is the question. Bank of America saying they could do it 5 times. Goldman Sachs saying they'll start raising rates as soon as they finish tapering, which would put it at July 27th of next year. So it is going to be all about no longer how do they hold down rates, but how soon do they let rates go up?
Mike, let's just deal with the tapering story first before we race away and start talking about rates. You and I had a conversation this morning, and I think it's an important one. The chairman indicated that it was almost on autopilot. He didn't use those words, but he talked about unwinding the program down to effectively nothing by the middle of next year. I wonder if there's a bit of pushback, some clarification there from the chairman this week on how flexible that unwind of that program is, Mike.
It wouldn't surprise most people in the markets. Powell probably saying they would get it done by the middle of next year in order to reduce bond market volatility, but we're getting some of that volatility back as people move from tapering to rate increases, and they're tied in that sense. They don't want to start raising rates until they have finished tapering, because then they're working against each other. So we may hear the chairman say something about the Fed responding to economic conditions. They want it to be sort of boring and on autopilot, but if something happens, they will react.
My communication has changed, and it has changed. It's changed at the ECB, where we didn't get a huge pushback from President Lagarde on where the market was trading. Not much pushback there at all. We've had encouragement from the Bank of England. We've had an absence of anything from the RBA. And from the Federal Reserve, we've had a bit of a communication shift as well. And I wonder from your perspective, Mike, whether that reflects a change in the balance of risks around the inflation story or a change in the base case. Which one is it for you?
Right now, I think it's the balance of risks for most people, because when everybody looks at the inflation data, no matter where it is, they see a lot of things that move because of supply chain problems on the supply side. And central banks influence the demand side. So there's a feeling that, yes, risks have gone up, but it may not be something that central banks can deal with. If you're in a smaller central bank, Norway or Czechoslovakia for those who are following them, the Czech Republic, not Czechoslovakia, they've got to react. But the big central banks, especially the Fed, they can take their time.
Mike, and we didn't even talk about payrolls. Thank you, sir. Looking forward to the coverage of the ISM in about 10 minutes' time. On the payroll story, 450,000 is the median estimate. Don't let that mislead you too much. Look at the range of estimates from Wall Street. Once again, incredibly wide. We do this every single first Friday of the month at the moment. Wide, wide, wide. 700K, the high estimate. At the low end, 250,000. That's a 450,000 spread, again, on payrolls. And we're looking back to October in November. This is not what I thought we'd be doing for the whole of this year, with ranges that big on the street, trying to work out what on earth is going on in this labour market. Let's check in on the price action, all-time highs in the equity market. Lift the lid, break it down. Some sector price action with Kriti Gupta. Hey, Kriti.
Well, good morning, John. Green on the screen, over 70% of the S&P 500 led higher at the top of the pack by the energy sector, of course, as we start to see Brent hit that 85 handle. And next up, you have consumer discretionary. A good chunk of those gains are coming from Tesla. Of course, you do have them rising for a fourth straight session. At the bottom of the pack, big tech leading the way lower. But I really want to zoom in on that lithium and battery index. This, of course, like I said, Tesla gaining much, much higher. The top weight in the index is Tesla, up 10% of the index. And then you, of course, have them expecting to address green energy over at the COP summit, as well as Biden talking potentially about those EV tax credits within that index. If you go past Tesla, you have Plug Power up a whopping 7%, fuel cell energy up a whopping 9%, even Ford and GM trading higher, in sympathy after giving those big EV investments that they were talking about last week, John.
Kriti, thank you. Thank you very much. Just want to check in on American Airlines just once more. We talked about that briefly around the opening bell. The stock was lower by about 1% and change. We're now negative just a third of 1%. Quarter to quarter now, that stock recovering after cancelling 1,500 flights over the weekend. Was it the weather? Was it the weather, or was it a struggle to access the people they need to fly those planes because of some mandates out there? Look, this is a conversation that's taking place right now. It was taking place with Southwest a number of weeks ago. It's taking place with American Airlines over the weekend and into this morning. We mentioned the Bank of England very briefly about the close call we could get this coming Thursday. Michael Reed out of London at Bloomberg has broken down some of the estimates. Get away from some of the median estimate in these stories, whether it's payroll, central bank decisions. Just look at the division on Wall Street and in the City of London around issues like this. 23 survey respondents in our survey here at Bloomberg expect rates to remain unchanged. 22 respondents expect a 15 basis point hike to 0.25%. Just gives you an idea of how divided the street is on, say, payrolls, or the square mile is on Threadneedle Street, and what happens next at the Bank of England. Some of the issues we'll talk about through the week. Up next, I'll get you the trading diary. What a week we've got in store for you. From New York City, this is Bloomberg.
Okay, guys, great, well done. Position open at 115,733. Stay with me. If you don't have a strategy, stay with me, and basically I'll let you know what's going to happen next. After, when we move away in our advantage, we'll place stop so our position. You can call it stop on profit, and or some people call it stop loss, that they won't lose any money. I prefer to call it stop on profit. Okay, and then we will move further and further. For you guys, mostly for you, you got the strategy, so you know what to do. Okay, if it will go against us, we will arbitrage this position, and you also know how to do this. Okay, stay safe. I'll speak to you later. Okay, guys, I also place a stop for Japanese yen. As you can see, we have short position at 114,282. Okay, and I'm placing an order to sell if it will change direction at 114,252. It will give us 30 pips. For Japanese yen, it will give us 300 pounds in profit. Okay, so I'm going to place a stop for this position, and then I will re-enter at higher level. Okay, guys, stay safe. Okay, traders, I'm going to move further my stop for Japanese yen to 114.232. It will give us 500 pounds in profit. Okay.
Beautiful, intelligent, and kind, which was, I mean, something that I was looking for.
Anshu and Sumit are one of about 12 million couples that get married in India every year. Unlike their parents' generation, they're not from two close villages, but from two cities on opposite sides of the country. And their love didn't start through community matchmaking, marriage brokers, or classified ads in newspapers, but began online.
So we met through jeevansathi.com. So it's basically an online portal where we have detailed profile of different grooms and brides.
It makes a lot of remote profiles who are located in distant areas more accessible.
Thanks to growing internet and smartphone usage, matrimony websites and apps in India are starting to disrupt the matchmaking industry. More and more people are finding their partners at the click of a mouse. jeevansathi.com, where Anshu and Sumit met, is one of the biggest players. Young Indians looking for love set up profiles including their caste and horoscope, but their criteria for choosing spouses appears to be changing.
We have seen the shift from, traditional caste community conservative parameters to something like which is more focused on education, employment.
Anshu and Sumit's marriage was initiated by their parents, but modern Indian couples like them have more input than previous generations.
We looked up to them to agree for the proposal, but it was primarily our decision that we wanted to be with each other.
So what's the emoji like you use the most to send to each other?
There's a bear which basically we use for indicating a hug.
Yeah, that's our language basically, bear icon for a hug.
Time flies when you're in love, and just 1.5 months after they first met online, the couple got engaged. They decided to hold their wedding less than 3 months later. But planning a traditional Hindu wedding on such short notice is no easy task. The massive event usually lasts 3 days, has various ceremonies and celebrations, and involves the entire two families and hundreds of guests. Luckily, there are websites and apps for that.
We searched online, we got in touch with Wedding Brigade, and they helped us finalize the venue. And it makes the search faster and efficient.
Startups like the Wedding Brigade are challenging traditional wedding planners in this $50 billion industry. It provides various services from booking banquet venues to buying wedding gowns. The website makes money by charging commission from vendors.
People don't want to be limited to what is available around them. They want to know the entire range of options available before making a decision. And now it's easy to find almost everything on one portal.
Anshu and Sumit are officially married in a ritual that has gone on for thousands of years, but their love started in a very new way. Technologies might be changing the way couples meet, date, and get married in India, but they're definitely not changing everything.
The technology was only the first level help that we could get to find each other. Everything else was like very humanly and emotions and feelings based.
Okay, guys, are you up to British pound? I'm going to place an order to buy British pound, and the price I'm looking to buy, let me tell you, it's already moved down, so I need to wait until something will stabilize, because it's right now some news probably appeared, and the buyers trying to buy, sellers trying to sell. But I was looking right now to buy British pound, so be ready to trade British pound anytime. Okay, let's see what's going to happen later on. For time being, I leave you, and I'll keep an eye on British pound right now. Okay, guys, I'll speak to you later.
Massachusetts Senator Elizabeth Warren has become a symbol of everything the Republican Party stands against.
Everyone gets a right to basic health care. We need strong oversight of these banks.
A legal scholar and a consumer advocate turned politician, Warren has branded herself as a champion of the working class and made a career out of standing up to big business. While rumors of a 2020 presidency bid remain just that,
I'm not running for president.
Her Senate seat is up for re-election in 2018, and Republicans are already pumping millions into super PACs to defeat her. This is the story of how a law professor and politician came to be seen as the biggest threat to Republican values and the greatest hope for progressive America. Elizabeth Warren was born Elizabeth Ann Herron, the youngest of three siblings, on June 22, 1949 in Oklahoma City to middle-class parents. After waiting tables to help her family pay the bills, Warren became a star on the high school debate team. She landed a scholarship to George Washington University at the age of 16, but 2 years later dropped out to marry her high school sweetheart, Jim Warren. By 1980, Warren was a mother of two, divorced and remarried, had earned a bachelor's degree from the University of Houston, a juris degree from Rutgers, and practicing law in New Jersey. Warren then went on to become an influential law professor, teaching, lecturing, and publishing highly cited work on bankruptcy and commercial law at 7 universities around the country, eventually settling at Harvard Law School. But Warren wasn't always a liberal lion.
Elizabeth Warren used to be a Republican, actually.
That's Stephen Dennis.
I'm a Senate reporter for Bloomberg. Around the time that Elizabeth Warren switched parties, she became a fierce opponent of a Republican drive to make it much harder to file for bankruptcy. She fought that for a decade. It ended up passing anyways.
While her efforts ultimately failed, her warning calls were heard in 2008.
We're in the midst of a serious financial crisis. Our entire economy is in danger, and without immediate action by Congress, America could slip into a financial panic, and a distressing scenario would unfold.
Professor Warren was tapped to help with oversight in the government bailout.
She would excoriate bankers and their bonuses and their practices.
Why should the U.S. taxpayer alone carry Citi?
She proposed a series of tough regulations, which became the basis for much of the Dodd-Frank financial law that we have today. That sort of catapulted her to national stardom, particularly among the progressive left.
Encouraged by her newfound notoriety, Warren declared her bid for the U.S. Senate on September 14, 2011. During the race, her opponent Scott Brown tried to derail Warren by accusing her of falsely claiming Native American heritage, a controversy that earned her the nickname Pocahontas. Nevertheless, she was victorious and won the Senate seat by a comfortable margin. She used her new tenure to challenge everyone, from banking regulators and Treasury officials to members of Wall Street and Congress.
I'm really concerned that too big to fail has become too big for trial. We need tough new laws to hold corporate executives personally accountable. No one should be above the law.
She called for Wells Fargo CEO John Stump to resign for fraud, introduced the Bank on Student Loans Fairness Act, and reintroduced the 21st Century Glass-Steagall Act. In 2016, after staying silent during the Democratic primary battle, Warren finally endorsed Hillary Clinton and had some harsh words for candidate Trump.
Donald Trump is a loud, nasty, thin-skinned fraud who has never risked anything for anyone, and that is just one of the many reasons he will never be president of the United States.
But she was wrong.
The forgotten men and women of our country will be forgotten no longer.
Warren wasted no time resisting Trump's agenda.
Have you ever managed or overseen a $1 trillion loan program?
I have not.
How about a $1 billion loan program?
I have not.
Okay.
In the Donald Trump era, Elizabeth Warren has been playing defense and trying to prevent Donald Trump and his cabinet appointees from rolling back protections that she helped enact.
Warren actually found herself rebuked by Mitch McConnell for reading a letter by Coretta Scott King about Jeff Sessions' record on racism during his confirmation.
She was warned. She was given an explanation. Nevertheless, she persisted.
That moment became something that's on T-shirts, bumper stickers, slogans, and that really galvanized a lot of support for her. It's been very hard for Republicans to get much of anything done this year, and that's at least in part to this resistance movement that Elizabeth Warren has helped champion.
We are here to fight back.
Enough of Elizabeth Warren. Like you.
Millions of dollars are being funneled to defeat Warren in the midterm elections in 2018. But it's the rumors of a 2020 presidential bid that has further prompted powerful donors to fund her opposition, often using the same playbook of constant and ruthless ad campaigns that many believe helped Trump win in 2016. It's anyone's guess if she will endure what Hillary could not.
You know, the question for Elizabeth Warren is whether she can go from being a liberal firebrand to somebody who can regularly get 60 votes for initiatives in the Senate and 218 in the House and drive an agenda, and whether she can bring together coalitions for political victories. That's the challenge, and we'll see what happens.
Sadiq Khan, the mayor of London, has made some powerful opponents.
He doesn't know me, never met me, doesn't know what I'm all about. I think they're very rude statements, and frankly, tell him I will remember those statements.
My message to Donald Trump and his team is that, your views of Islam are ignorant.
He's the first Muslim mayor of a major Western capital and proud of it. This is how Sadiq Khan went from the son of Pakistani immigrants to a lawyer, lawmaker, and now the mayor of London. Khan's parents emigrated from Pakistan. His father was a bus driver, his mother a stay-at-home seamstress. The 10-strong Khan family squeezed into a 3-bedroom flat in South London. He wanted to be a dentist, but TV in the 1980s convinced him otherwise.
Objection!
LA law, with its swagger and ill-fitting suits, caught Khan's eye. He graduated in 1991 with a degree in law from North London University and joined a human rights firm. Khan worked a number of high-profile cases, often clashing with London's Metropolitan Police Force. But he had bigger political ambitions.
This is what being a new MP is like, squatting on a bench in the absence of an office, dealing with letters from constituents.
Reports are just coming in of an explosion here in London.
And there's just explosions, and then it was just smoke everywhere.
Everyone's just asking what's happened.
Only 2 months after Khan entered the Commons as a Member of Parliament, London was attacked by Islamist extremists.
That day will stay with me for the rest of my life.
He spoke out against the attacks both as a London MP and as a Muslim.
He has been very clear about his opposition to violence, opposition to terrorism, and has set out to make the case for a more open and peaceful Islam.
That's Thomas Penny, one of Bloomberg's Westminster correspondents.
Here is a man who is a Muslim, and he is standing up and being open and straightforward and being clear that the problem here is not Islam, but it's Islamic extremism.
In 2015, a decade after the attacks, Khan ran for mayor of London, and his faith was back in the headlines. His opponent, Zach Goldsmith, trying to link Khan to radical Islam.
The debate got again personal and nasty.
The Goldsmith camp has called Khan extreme and accused him of associating with, quote, those who seek to do our police and capital harm.
It's a pattern of behaviour.
Even the former Prime Minister David Cameron repeated the allegations.
He shared a platform with Sajil Shahid, the man who trained the ringleader of the 7/7 attacks and accused the United States of bringing 9/11 on themselves.
But the smears didn't stick.
Zach Goldsmith ran a very negative campaign that was based on what people knew was a lie.
This election was not without controversy. And I'm so proud that London has today chosen hope over fear and unity over division.
After taking the mayor's office with a comfortable majority, Khan has brought a business-like efficiency to the role, scrapping expensive vanity projects like the Garden Bridge and the new Routemaster buses, which cost £350,000 each. The former lawyer who used to fight the police in court is now praised for his close relationship with them.
I was talking to a very senior police officer in the Metropolitan Police who said there was a sea change when he went into City Hall, and the police were saying how much they welcomed this because they knew where they stood and it was more straightforward to work with. So he works like a lawyer, he works like a government minister.
Khan's kept his faith at the fore. He's an outspoken voice for moderate Muslims across the world.
Donald J. Trump is calling for a total and complete shutdown of Muslims entering the United States.
Now, by giving the impression that Islam and the West are incompatible, you're playing into the hands of the extremists.
The ongoing spat between Khan and US President Donald Trump escalated when Trump went after Khan.
Okay, guys, I'm going to open short position for British pound. Okay, I'm placing an order to sell short at 136.738.
Found Khan was more trusted to keep the country safe from
136.7.
the Labour leader. His story of going from the son of a bus driver to the mayor of one of the greatest cities in the world plays well with...
I placed an order to sell short British pound pair against United States dollar. Okay, if you got the strategy, you know what to do. Please place an order. If you just copy trade, please also place your order if you follow my trades, and we will trade British pound right now. I will move my order to sell short at 136.739, a little bit higher. Okay, I'll speak to you later, guys. Okay, guys, position opened on British pound 136.739. Okay, great. Stay with me if you decided to trade British pound. Don't go anyway, and we will go through this trade together. Okay, guys, stay safe. I'll speak to you later.
What does it take to change the world? A big army? A cure to a pandemic? A revolution? All of these take either a lot of people, thousands of hours, or massive amounts of space. But for Julian Assange, all he needs is one room, an internet connection, and the world will listen. Assange is located here, and more specifically, right here. And from that location, he's posted government secrets, classified documents, and leaked emails from some of the world's most powerful people. And in doing so, has been labeled a hero, a villain, a nihilist, and everything in between. This is how an Australian programmer sequestered in the Ecuadorian embassy in London became one of the most influential and notorious people in the world. Born in 1971 in Townsville, Australia, Assange has always been on the move. Living in over 30 homes by the time he was in his mid-teens, Assange, along with his mother and half-brother, finally settled down in Melbourne. His introduction to hacking started at 16 when he was given a Commodore 64, which he attached to a modem. He attended the University of Melbourne, where he studied programming, physics, and mathematics. He never graduated, but that doesn't mean he didn't get an education. By 1991, Assange hacked into the Pentagon, U.S. Navy, and other branches of the U.S. government. In 1996, he was caught by the Australian Federal Police and charged with over 30 counts of hacking and computer-related crimes. He didn't get any jail time, but he was fined $2,100.
I think the first taste of what would come later was the hacking that he did as a young programmer, and that really sort of foreshadowed a healthy skepticism of the use and abuse of technology by governments.
That's Vernon Silver.
I'm a reporter for Bloomberg's investigations team.
Assange's youth as a hacker laid the foundation for him to start WikiLeaks in 2006. But what is WikiLeaks? It's a website that posts unfiltered, usually classified documents. What separates it from every other media outlet is that they have no editorial hierarchy. With a publication like the New York Times, information comes in, they take that information, package it, then disseminate it for the public to see. WikiLeaks, however, cuts out the middleman.
WikiLeaks gathers information, most of it given to them anonymously. So what they're doing is really very simple. They get the information in one end from who gives it to them and out the other with sometimes minimal interference. Julian Assange is the leader of that, the mastermind, the creator, and really, because he thinks of it as a journalistic enterprise, the editor-in-chief.
But every story starts with a source, and Assange has some unconventional sources.
Julian Assange does not hack as far as we know. He is the recipient of people who are either insiders who give him secret documents or hack emails from a foreign power.
That's Eli Lake.
I am a columnist for Bloomberg.
And there was no source bigger for Assange than Chelsea Manning. He used to be known as U.S. soldier Bradley Manning. In 2010, Manning provided Assange and WikiLeaks with hundreds of thousands of leaked government documents. WikiLeaks quietly began releasing the documents in February of 2010, then made big headlines in April by posting what is now known as the collateral murder video.
Come on, fire!
It was a vivid, graphic video. It changed the debate on the Iraq War, and importantly, it put WikiLeaks on the map when they put it online, and they couldn't be ignored at that point.
And those leaks were just the beginning. They went on to post more than 90,000 leaked documents known as the Afghan war logs, 390,000 documents known as the Iraq war logs, and 250,000 private messages between diplomats called cables in what is now known as Cablegate. These leaks were met with very real ethical questions.
The problem with publishing those cables was that a number of confidential sources for U.S. diplomats who faced real danger when their names were exposed.
Then Secretary of State Hillary Clinton drove the point home that
every country, including the United States, must be able to have candid conversations about the people and nations with whom they deal.
Shortly after Cablegate, the Swedish government issued an arrest warrant for Assange on allegations of rape and molestation. He claimed the allegations were fabricated to get him extradited to the United States, a claim the U.S. government denied. Either way, Assange's next move was
to seek refuge in the Ecuadorian embassy, which really was the beginning of the new chapter in his life and what we're dealing with now, which is him being stuck in London.
What was supposed to be an office in an embassy is now Assange's self-imposed prison to this very day. But that doesn't mean he's slowed down. Since being trapped in the embassy, WikiLeaks has released files about Guantanamo Bay prisoners, Syrian political figures, and the draft to the Trans-Pacific Partnership. And then came the 2016 U.S. election.
Thousands of leaked emails showed Democratic Party officials possibly plotting against Bernie Sanders in his race against Hillary Clinton.
Over the course of 68 days, WikiLeaks released 20,000 confidential Democratic National Committee emails. In terms of the presidential race, if you look right here, when Assange released the first batch of emails, Trump actually takes his first lead against Clinton.
I think we've had enough of the Clintons, in all fairness.
Once WikiLeaks started exposing secrets of the Democratic Party, Julian Assange became a hero to many on the right. Public opinion kind of flip-flopped.
WikiLeaks!
From the emails, we now know Hillary Clinton's campaign manager makes risotto, and also how the DNC squashed Bernie Sanders' campaign. One thing we don't know is who gave Assange the stolen emails in the first place.
Many leading Democrats say they suspect it was the Russians. They released an analysis from a private cybersecurity firm that had said it was the Russians.
But Assange claims
our source is not the Russian government, and it is not a state party.
So this is where we stand today. The public still doesn't know who provided the emails to WikiLeaks. Meanwhile, Assange is still running WikiLeaks and still releasing documents. In March 2017, he started publishing documents from the CIA's Center for Cyber Intelligence called Vault 7.
The CIA, the agency charged with finding and keeping our top secrets, can't keep its own secrets.
As long as Assange has a connection to the world, no government secret will be too far from exposure.
Julian Assange is still in the embassy. Maybe he'll leave, maybe he won't. Kind of regardless, his work has been done. He's changed the way people think about their governments, about their own secrets, about their own hackability, and really the world has changed because of him.
Okay, guys, let's place stop for euro. Okay, I'm going to place a stop for euro at 115.75.3. Will give us 2 pips in profit. Please place stop for your position. Okay, you will not close your trade in loss. Okay, guys. If you copied this trade a couple of hours ago, it's time to place, like I said, if you stay with me, it's time to place stop for this position. Okay? Stay safe and I'll speak to you later. Maybe it's quite a chance that we will move even higher our stop. Stay safe.
5G arrives, it could enable driverless cars to take us there as well. 5G stands for 5th generation mobile networks or wireless systems. It's insanely fast and can accommodate a lot more connection devices. But the reason it's being called revolutionary is because 5G will allow connected devices to speak to each other as well as people.
Right now we're living in a world where really it's a one-way experience.
That's Bloomberg tech reporter Ian King.
The network talks to your phone, you look at your phone and access data, then you send something back to the network. What we're being told about 5G is that really for the first time we're going to see machines communicating with each other over mobile networks in a meaningful way.
5G could end up being 100 times faster than what we have now, with speeds that could reach 20 gigabits per second. In plain English, that means downloading a full-length HD movie in seconds. 5G will also increase total bandwidth, which we will need in order to accommodate the growing Internet of Things. We're talking about the class of devices like internet-connected refrigerators, thermostats, dog collars, but 5G will enable many, many more.
Things like your utility network, factories, where machines are just sat there not connected at all. Suddenly they're all going to be connected. Suddenly we're going to be able to have real-time monitoring. Other things like cars, like utility poles, like your light, the light poles.
But perhaps the biggest advance will be a huge reduction in communication lag time, known as latency. A network of driverless cars will need the speed of 5G to ping each other multiple times per second to avoid collisions. Near instantaneous data transfers could allow doctors to perform surgery remotely with a robotic scalpel. So how will all this work? First, you need to improve network density.
And that's just a fancy word for saying you put more towers out there. What we're being told is that's not actually the case with 5G.
The idea is 5G will not only use the existing mobile spectrum, but also tap into higher frequencies called millimeter waves. Millimeter waves can carry more data, but only travel short distances. This may mean you'll see a lot more of these base stations around town. And the new towers may have as many as 100 antenna ports, compared to about a dozen on 4G cell towers. So when will we get 5G? Getting 5G ready is expected to cost providers $275 billion over 7 years in the US alone. Look for the first 5G service to pop up in big cities sometime in 2019.
People think of Vladimir Putin, they think of capital P, power. And that's exactly the impression he creates. Whether it's physical power, firing different weapons, riding in various James Bond-esque modes of transportation, or tossing hapless opponents in judo. Or political power, ruling his own country with an iron fist, crushing his political opposition, or, most recently, being accused of meddling in foreign elections for his own benefit. This is how Vladimir Putin went from a poor, tough kid in Leningrad to a KGB spy to the very symbol of modern Russia. Vladimir Vladimirovich Putin was born in 1952 in Leningrad, which is now St. Petersburg. His father was a factory foreman and his mother a homemaker. It is widely said that Putin's public-facing tough guy persona can be traced back to him getting into fights when he was younger, which paved the way for him to take up judo. After getting a law degree from Leningrad State University, Putin joined the KGB Foreign Intelligence Service. He spent 16 years in the KGB. When Putin returned to Russia, he began his political career.
He went to work for Anatoly Sobchak, who was then the mayor of St. Petersburg.
That's Leonid Bershidsky.
I'm a columnist at Bloomberg View.
Putin thrived in Sobchak's administration because
he was sort of considered pretty efficient city official at that time. He was very loyal to Sobchak.
So loyal and efficient that
he was noticed by Yeltsin's close circle.
And those people soon brought Putin over to Moscow to work in Yeltsin's administration, where he quickly climbed the political ladder.
Then, of course, he was promoted to Prime Minister of Russia.
That's Dmitry Trenin.
I'm currently director of the Carnegie Moscow Center.
Around this time, Yeltsin and the people around him, the so-called family, decided that Putin would become Yeltsin's successor. And then this happened. The apartment bombings were carried out in 3 Russian cities, killing 293 people and injuring more than 1,000. Putin immediately accused Chechen separatists for the bombings and followed it up with action.
He was credited with having a very successful military campaign against the terrorists.
And it worked.
After that, he became an heir apparent in the eyes of the Russian people.
3 months later, Yeltsin resigned. And on his way out, a famous exchange.
He was getting into the car in the Kremlin, and the last words that he addressed to Putin before getting into his car was, "Take good care of Russia."
So Putin took over as president, and 3 months after that, won his first election. But just because Putin won the presidency, that didn't mean he had all the power. This is Michael McFall.
I was U.S. ambassador from 2012 to 2014. In the 1990s, there was a fire sale of all the things worth owning in Russia, and certain people,
the oligarchs,
did better than others in that fire sale, sometimes called privatization, and those people tended to be well connected with the Yeltsin regime, and they weren't Putin's friends. But they probably miscalculated, thinking that they could easily find a way to influence him. It became impossible almost from the start.
From that very moment, there was warfare between him and the oligarchs.
That's when Putin gave the oligarchs a choice. Putin's way?
Some of those people from the 90s managed to figure out a new way of dealing with Putin and have survived.
Or prison.
Others could not find common vision, and so they lost their assets.
Khodorkovsky once was Russia's richest person, worth $15 billion, but he ran afoul of President Vladimir Putin and spent a decade in prison.
With domestic power consolidated, Putin focused on restoring Russia's global influence.
Putin is the guy who believes in the expansionist Russian state. Georgia and Ukraine and all the other Soviet republics that split off when the Soviet Union fell apart, he still believes that they're traditional Russian satellites. A lot of his strategy is about keeping them in the orbit. That Yeltsin line, take good care of Russia, that's how he understands it.
And he used annexation and invasion, as well as oil, gas, and trade to keep former Soviet republics in Russia's orbit. In 2008, Putin's 2 terms were up, and he decided to step down as president. Dmitry Medvedev stepped in as president, and Putin went back to prime minister. But really,
Putin never left power. He pretty much continued running the country, and Medvedev was a bit of a figurehead.
There was actually a period of cooperation between Russia and the U.S. that benefited both countries during Medvedev's presidency.
Because Medvedev did not have the same negative attitude towards the West as Putin did.
But when Putin came back to run for a 3rd term, in the lead up to the 2012 election, it was widely believed that both the presidential and parliamentary elections were rigged, and Russians took to the streets. Putin blamed the protests squarely on America, and more specifically, Secretary of State Hillary Clinton.
He believed that she had sent, and this is his words, a signal to demonstrators.
Still, Putin won by a huge margin and set about crushing the protest movement immediately upon his return to the Kremlin. Over the next few years, Russia's economy tumbled. Putin annexed Crimea, leading to sanctions. The price of oil fell drastically. The ruble hit a new low, and America played down Russia's influence, with Obama calling Russia a regional power. Despite...
Okay, traders. I'm going to move our stop first of all. Stop for euro higher to 115. 73. We will move 78. We'll give 5 pips. 78.3. Okay. Also, I'm going to move stop for Japanese yen. We'll move our stop to 114. Let's see, this is interesting. So 114 to 32 left, it will give us 5 pips. 114 to 12. Okay, it will give us 70 pips. Okay, in our case it will give us £700 in profit. Okay guys, I'll speak to you later. I don't know guys if we've been holding this position for a couple of weeks on Japanese yen, because as you can see, we have at 109 short position. We're not paying anything overnight because we're trading on margin and broker charges if we have a long position. For short position, broker pays us, so this is kind of we're not losing at all. We wanted to hedge this position, so that's why we sold at higher level, but it's look like it takes a while, so we will probably re-enter position at the higher level, or we will wait until the price will move lower to 109. Okay guys, stay safe.
Jack Ma is Asia's richest man and most recognizable business tycoon. He's the chairman of Alibaba, China's e-commerce giant and one of the 10 largest companies in the world, yet he still wants more.
We know where we're going. We want to be the 5th largest economy.
Big words from the man some call Asia's Jeff Bezos. He's confident, he's charismatic, and he's definitely not the average CEO. This is how a poor school teacher went from the classroom to being one of the most influential multi-billionaires in the world. Ma was born in China's southeastern city Hangzhou in 1964. His parents were traditional musician storytellers. As a teenager, he started to learn English from foreign tourists after China opened up in the late 1970s.
And then for 9 years, Jack Ma hung around outside the Hangzhou Hotel, which is now called the Shangri-La. He would get up at 5 a.m. to talk to travelers.
That's Bloomberg technology reporter Lulu Chen.
And I cover China Internet for Bloomberg.
Ma failed China's National University entrance exam twice before being admitted to local teachers' college. He graduated in 1988. He applied for 30 jobs and got rejected, including from the fast food giant KFC.
When KFC come to China, come to us, say, 24 people went for the job. 23 people accepted. I was the only one guy.
Then Ma got a job at a local university and taught English there for about 5 years, earning just $15 a month. On the side, he started a translation company with several friends. During a company trip to the US in 1995, Ma had his first encounter with the internet at a friend's place in Seattle.
I searched the first word, beer. I don't know why, because it's easy to spell, baby. And I see beers from Germany, beers from USA, beers from Japan, but there's no beer from China.
So he searched for the word China instead and still couldn't find anything. And that got him thinking. He wanted to build something that would put China on the world's map.
He started China Pages, a Yellow Pages-like website, but it didn't take off. Then Ma joined a government agency in Beijing to help set up a website. By 1999, the internet stock boom had gripped Wall Street, and back in his Hangzhou apartment, Ma decided to try again. With his wife and a group of friends, Ma raised $80,000 and set up Alibaba, a site that allowed businesses to sell stuff to each other.
人家美国人强就强它的硬件，强就强它的系统建设，这方面确实比你早。但是玩信息玩软的，中国人的脑袋绝不比你们长。我们在座的所有人的脑袋绝不比你们长。
By 2000, Alibaba had raised $25 million from investors, including Goldman Sachs and SoftBank.
He had no business plan and zero revenue, but his eyes was very strong eyes.
In 2003, Alibaba started Taobao, a platform for individual sellers to trade with each other, and publicly declared war against eBay, who had started to make a foray into China.
Jack Ma has this famous saying that Alibaba is a crocodile in the Yangtze River, whereas eBay is a shark in the ocean. And if they fight eBay in the ocean, then they'll lose. But if they fight them in the Yangtze River, then they have a home base advantage.
In 2007, just 1 year after it forced eBay out of China, Alibaba debuted its business-facing division on the Hong Kong Stock Exchange. But it delisted 5 years later as its performance sagged. But in 2014, Alibaba raised $25 billion in the world's biggest IPO in New York.
Everybody should have a dream. What if that dream comes true?
After achieving dominance in the business of e-commerce in China, Alibaba has been building an internet empire worth $472 billion, with businesses in cloud computing, online video streaming, movie production, healthcare, sports, retail, and even news media.
Alibaba buying into South China Morning Post really raised eyebrows. This is the largest English newspaper in Hong Kong, and it shows that Jack Ma's ambitions weren't limited to e-commerce. He wanted to influence not just Chinese users, but also overseas users as well.
The US has criticized Alibaba for allowing companies to sell counterfeit and poorly made goods, but in China, it enjoys the favor of China's government. It's part of Ma's company philosophy.
In love with the government, but don't marry with them.
Jack Ma is an extremely fortunate man for jumping on the internet sector so early. Note that this is a person who has no coding skills at all. He's a natural showman and a gifted public speaker and really able to convince others to believe in his vision.
Ma's vision of growing Alibaba to be the world's 5th largest economy faces strong competition at home and abroad. It will require more than just naked ambition and charisma, but Ma is great at getting himself in the right place at the right time. So far, it's served him well.
Thiel is a walking contradiction. He got his bachelor's and Juris Doctorate from Stanford, but speaks out about the horrors of higher education, saying college is
as corrupt as the Catholic Church was 500 years ago.
He's a staunch supporter of the free press, yet he bankrolled a lawsuit to bankrupt an independent media company.
But these were not journalists.
And most of all, he's an immigrant libertarian who's the most public supporter of Donald Trump in all of Silicon Valley.
What Trump represents isn't crazy, and it's not going away.
This is the story of how an openly gay, immigrant genius, libertarian billionaire went from tech contrarian to Silicon Valley's biggest Trump supporter. Peter Thiel was born on October 11, 1967 in Frankfurt, West Germany, to Suzanne and Klaus Thiel. Peter's family emigrated to Cleveland, Ohio when he was 1. An Ayn Rand devotee during his youth, Thiel attended Stanford University majoring in philosophy.
His Stanford experience shaped a really big part of who he decided to surround himself with.
That's Lizette Chapman.
And I cover technology and venture capital here at Bloomberg.
He and his Stanford friends made their first big splash in tech with PayPal. After selling to eBay for $1.5 billion, they would become known as the PayPal Mafia for each incredible success after PayPal. For Thiel, that began with an early, modest $500,000 investment in Facebook.
And in VC speak, early means big risk, but also big reward. He turned that initial $500,000 investment into more than $1 billion in cash.
But Thiel was just getting started with Facebook, and he went on to make a whole bunch of wildly successful investments.
From SpaceX to Airbnb to one of the largest, most powerful companies in the United States, if not the world, and of course that's Palantir.
The incredibly controversial secretive data mining startup he founded with his colleagues from PayPal. It connects data silos and then allows non-technical people to search that information for patterns. Data like
financial information, feeds from video cameras, biometric details, passport information, flight manifest.
Palantir doesn't talk much about how they collect this data, who has access to it, or what they do with it. But they have contracts with
the Department of Homeland Security and the CIA and the Department of Justice and the Securities and Exchange Commission
and several other federal agencies. It's the richest company you've never heard of, valued at $20 billion. But there are plenty of obscenely wealthy people in Silicon Valley. What makes him different...
He's a complex ball of multiple contradictions.
Take college, for example. Even though college was extremely important for Thiel, there's something called the Thiel Fellowship.
In exchange for dropping out and a promise not to pursue college, Thiel would give them $100,000 each.
You basically tell people that if you get a diploma, you're saved. Otherwise you go to hell. You go to Yale or you go to jail.
Also, his relationship with the press.
Here's another contradiction. He's donated to free press initiatives, including the Committee to Protect Journalists.
But he also secretly spent tens of millions of dollars bankrolling a lawsuit filed by Hulk Hogan over the publication of a sex tape and bankrupting the independently run Gawker Media. Why did he do this? Because in 2007, one of Gawker Media's blogs, ValueAg, outed him as gay. And with the lawsuit, he
found an opportunity to get back at them by funding the lawsuit that Hulk Hogan was able to bring then, but he wouldn't have been able to do that without Thiel's money.
And finally, Thiel's biggest contradiction, his endorsement of Donald Trump.
When he was asked about his support for Trump, he was surprised at the outrage that came with it from many of his colleagues in Silicon Valley. He didn't want more of the establishment.
No matter how crazy this election seems, it is less crazy than the condition of our country.
After briefly supporting Carly Fiorina in the primaries, Thiel pivoted to Trump, donating $1.25 million to Trump and his associated super PACs in October 2016. And he didn't just help Trump financially. He gave a full-throated keynote speech supporting Trump at the Republican National Convention.
I'm not a politician, but neither is Donald Trump. He is a builder, and it's time to rebuild America.
And when Trump was finally elected, Thiel was given the reins to an enormous amount of power.
And I want to thank you, man. You have a very special guy.
He was named the transitional advisor. And in that role, he did a lot of interviewing and a lot of vetting to fill hundreds of cabinet positions and different jobs within the administration.
But it turns out Thiel's support isn't unconditional.
Talking to people who spend time with him, I have also heard that he is no longer a great supporter of Trump.
It was reported that Thiel was unhappy with the direction of Trump's presidency. Ever since, he's been mum, making no public appearances, no statements, and staying out of the spotlight altogether. Although there have been suggestions that Trump could tap Thiel for a top intelligence post or ambassadorship, there's no indication he'd accept.
He's described his relationship with politics as schizophrenic. He gets really involved, and then he runs away as fast as possible.
Whether Thiel takes a new position or simply continues as a board director at Facebook and Palantir, at just 50 years old, he's primed to wield some serious influence in technology and politics for decades to come.
Two 2016 was again the hottest year on record, and the previous 17 years have seen our 16 most scorching. Scientists overwhelmingly agree. Global warming is the culprit. And it's just getting started. Ice caps, extreme weather, wildfires, droughts, and the hits keep coming. What are we doing about it? In 2015, the world took its boldest step yet to stem climate change with a historic accord in Paris. But now comes the hard part. Nations must change energy policies and invest huge amounts of money, and they will likely do it without the United States. President Donald Trump announced on June 1st.
Okay, traders, position closed on Japanese yen. As you can see, just right here. Okay, we have 700 pounds in profit. Okay, well done, guys. Let's move on. We're moving nicely towards our bigger profit with euro. So stay with me. I'll speak to you later.
In an effort to avoid the rising seas and other environmental disasters that climate models predict. But even if all pledges are met, the globe is expected to warm by as much as 3.4 degrees Celsius this century, more than the UN target of well below 2 degrees. Meeting the Paris Agreement means that governments will have to offer more incentives for clean energy, scale back support for fossil fuels, make emissions more costly, and reduce deforestation. It's estimated that the deal will require $13.5 trillion of spending through 2030. Here's the argument. Unlike past climate pacts such as the Kyoto Protocol, each country set its own Paris targets and then promised to revisit and improve them. The U.S. was primed to play a lead role in climate change, but Trump's energy independence executive order reverses Obama-era rules and directives put in place to combat climate change, and expands production of coal, the dirtiest fossil fuel. The resulting policies threaten the global fight against climate change. Without the U.S. commitment to emissions reduction, other countries may join it in abandoning the Paris Agreement. This could make it almost impossible and even more expensive down the line to stop climate change. Optimists argue that the shift to a lower carbon future is already underway. Businesses, cities, and U.S. states, such as California, are already investing in wind and solar and taking other steps to make it work.
I've actually been called an environmentalist, if you can believe that.